there is a sentiment overhang?
We're coming to a point in the AI transformation where dispersion is much greater.
The AI boom is coming.
Rotation is the new momentum trade.
I think there's a number of narratives going on, and so investors are increasingly wondering, which ones do we want to pick?
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Friday, struggling to bounce. Amazon stock plunging after pledging to spend $200 billion this year. After tech stocks posted the biggest three-day rout since Liberation Day. And weaker than expected data sent bond yields down the most in months. We begin this hour taking stock of a brutal week on Wall Street, following a rout across tech, precious metals and crypto. A single Anthropic plug-in providing even more fuel for the software sell-off, spreading across the stocks of private market firms from Blue Owl to TPG. The risk aversion taking on a different flavour going into the weekend as several data points are poking holes in the bull case for the US economy, opening the door to a conversation about rate cuts.
The anatomy of this week is notable for how varied it is. It started with what you were talking about, the rout in software stocks, the potential of Anthropic disrupting fundamental business models and potentially increasing the default risk of some of these companies. It has shifted into, well, how much can this bull market keep running if you don't have the pillars of a strong economy behind it? Yesterday, we got a 1-2-3 punch. We got the challenger job announcements that came out. Then we got jobless claims that were elevated at 8-week highs. And then we got the JOLTS data that came out that showed that job openings fell to the lowest level since 2020, not boding well for the U.S. economy.
Governor Waller is looking smarter and smarter by the day over the last week or so. He said this recently. There is considerable doubt about future employment growth and suggests that a substantial deterioration in the labour market is a significant risk. Now, we can have the debate about it all, but it's certainly a risk.
And he's been consistent. He has been saying this for months, and most recently saying he is still very concerned. And basically, everyone was looking for, why did this individual go out and dissent at the last meeting? Was it just because he was running to be the Fed chair? Governor Waller came out and said, no, it's because I'm concerned about the labour market, and maybe he was right.
So we got real economy concerns on top of a rout in tech stocks and massive moves in private market firms. KKR, TPG, Blackstone, Apollo, all softer this week. Check out Blue Owl, down for 11 consecutive days. We're down 15% this week alone.
And they came out and they tried to stave off some of those concerns by saying, look, software-related debt is only about 8% of our portfolio. The market's response, we don't believe you. A similar response from Ares as well. People not taking any of these assertions as fact or any kind of placation for some of the concerns. It raises this issue. How are some of these companies going to finance these very ambitious plans at a time where, yes, their cash flows are really ample, but ultimately it will come down to some of the credit financing? How willing are people to go and continue to extend that?
They're struggling to put this story to bed. Ari is saying there's a huge disconnect. The narrative is wrong. KKR's Scott Nuttall saying our level of anxiety is pretty low for them, for the management teams. But right now, if you're holding the stock, I imagine you're pretty anxious.
Blue Owl also saying their technology, that part of the portfolio, is the most pristine. Quote, we don't have red flags. We don't have yellow flags. We actually have largely green flags. Well, I'll tell you, those stocks are anything but green this week.
So here's the bounce so far this morning. Equity futures on the S&P positive by 0.5%. We'll see if this sticks. Coming up this hour, we'll catch up with Brian Levitt of Invesco on a three-day stock market rout. Sarah Kunst of Clio Capital as big tech's capex balloons. And Vivek Arya of Bank of America as chip stocks cash in on the spending boom. We begin this hour with stocks inching higher following a three-day decline. Brian Levitt of Invesco writing the story is far from fully written. We expect leadership to rotate as the market differentiates actual earnings leverage from all the hype. Brian joins us now for more. Brian, good morning. Good to see you.
Good to see you too.
What was the last 24 hours about compared to the previous 2 days?
I would say that this is a market that's been letting off some steam, certainly in the hotter parts of the market, and primarily, I think you got to look. If you look at the broad index level, these markets are not down all that much. I mean, Nasdaq down 5% over the last 5 days isn't great. S&P a couple of percent. It's really the carnage being hit in the software stocks and some of the more speculative parts of the market. You see it in things like what happened with silver prices and Bitcoin. But the reality is, when you look at all the investment that's likely to take place, we can parse whether the big companies at the top of the S&P 500 are right to do so. But if you look at industrials, if you look at energy, if you look at the semiconductors, it's all held up fairly nicely. And it's all part of that rotation story that we're talking about, less about who's going to win in that space, because that's going to be a big investment to win in that space, versus who's going to help support this build-out. That story continues to play.
That certainly felt real up until yesterday. And then the real economy scare kind of clicked in just a little bit. I don't want to overdo it, but just a little bit. A couple of data points poking holes in a bull case for the US economy. That's something we need to talk about, because people were piling into small caps. They were comfortable in the equal weight, close to all-time highs. Should they still be comfortable with those trades?
Yeah, I think so. And let's remember, we started the week with one of the great leading indicators of the economy, the Institute for Supply Management Purchasing Managers Index, which surged and climbed to 52. That's an expansion territory. We had not been there in quite a while. The new orders component particularly strong within it, and prices paid relatively flat. So that's a good leading indicator of the economy. Now, when you think about the jobs market, jobless claims rose yesterday. 250,000 is not a blowout jobless claim number. And it's also a little bit of a heads you win, tails you win type of scenario, because the weakness in the economy suggests what I've always believed is lower interest rates on the short end of the curve, which should continue to benefit lower capitalization stocks, more value-oriented stocks. So I'm not ready to say that this is a economy that's rolling over. Credit spreads continue to remain tight. Leading indicators are picking up. Inflation expectations relatively contained. I think the Fed's going to be bringing rates down towards 3%.
It might not be an economy that's rolling over, but it's a really confusing economy. And Amazon exemplifies it in a perfect way. On one hand, they were behind a significant portion of some of those job cut announcements that we got from Challenger, Gray, and Christmas yesterday. On the same level, they're going to be spending $200 billion so far this year. How important is it for us to understand exactly what they are spending this money on to be able to infer what kind of growth and benefit to the underlying economy that actually will look like?
Yeah, it's important. But if you take each component of economic activity, you take the consumer, we have to remember that, things may be weakening a little bit. Household net worth is at an all-time high. Unemployment's relatively low. The business investment we know is going to be big, as you mentioned, and the government spend is going to be reasonable this year, not only in the United States, but many parts of the world. So in aggregate, that's a good economic backdrop. Now, when you think of this investment that's going to take place, there's a lot of parts of the economy that should benefit from it. And again, industrials rallying, energy's been rallying, semiconductors were up 15% year to date before this week. So I think that story persists. Would I be diving back into software companies this morning after the sell? No, I'd be mindful of that. But I think the real economic story continues.
And this is arguably the main reason for the broadening out trade. The real question right now is, do you go into the hyperscalers, given the fact that their business model seems to be changing from asset light to basically glorified utilities and real estate managers?
Yeah, I mean, I would go case by case. It's certainly not a monolith. Big story last year was that only 2 of the 7 Mag 7 outperformed the market. And you're right, these stories have changed significantly. I mean, the things that we loved about some of these businesses was that they were near monopolistic, they did not have significant investment needs, and that all changes. So you got to go company by company, be far more selective, and can't say I'm just going to own the whole lot of them. There will be winners, there will be losers. Those business models have changed.
Brian, you say you're not going to wake up this morning and just go dive in and pick up some software company stock. Why not? Why isn't this a buy the dip moment?
Because for a lot of them, we still need to understand what does this really mean for the business model. And we knew all along AI is going to be quite disruptive for a lot of businesses. The question that investors should ask themselves over the next few years, is it disruptive to more businesses than it is beneficial, or is it beneficial to more businesses than it is disruptive? And I'm still in the latter camp. There is a lot of companies that are going to benefit significantly from the AI build. You're already seeing profits high with employment, profits to employment not significantly elevated. So we're in a bout right now where we're looking at the disruption, which always happens when there's technological advances. But history suggests that there's always far more beneficiaries than there are businesses that are disrupted.
Slightly different for you, though. A self-described FOMO guy who's not willing to lean into where the pain is right now. Is it fair to say? Bit of a change?
bit of a change, but I'm always looking for opportunities. So I have a fear of missing out, across the broad market. And so it doesn't mean that I need to always be buying into dips or into, falling knives, just looking for where the opportunities lie. And, again, that FOMO is good. That FOMO doesn't always exist, Jonathan, most of the time. And it exists when leading indicators of the economy are improving and the Fed wants to ease. I'm definitely a FOMO
At times, this has felt like a falling chainsaw and not a falling knife. Michael Arrighetti said this yesterday. If you're going to underwrite a narrative of AI disruption, you also then have to say, well, what does that mean for the productivity and margin improvement in the rest of your book? And I actually thought that was a really good point that he made just yesterday.
Well, that you could have an offset from some of the gains that you're seeing. For example, KPMG is saying, look, we're going to get lower prices because we can lower the costs of some of our accounting from AI. How much is that sort of the analog to a lot of other companies? That said, how many business models go to zero? And that is what people are scared of. And that is the reason why some of these stocks are falling out of bed. That is the reason why the loans tied to some of these software companies have fallen 10, 15 cents on the dollar in just a span of a week. This is a fear of a fundamental shift in the reality for this justification.
I'm so happy you brought up KPMG. I think it's astonishing that this Financial Times has this exclusive story that they're going to their auditor and saying, we know that AI is working. They should know because they also are an auditor. They're an accountant, and they're saying, we need a lower price or we're actually going to dump you. And that's what's going on right now behind the scenes in corporate America and global Wall Street.
I wonder how many people read that this morning and thought, you know what, I'm going to call KPMG and ask them the same thing.
Exactly. This is the disinflationary kind of boom that people are talking about. Question is, how many business models get absolutely blown out of bed and how many of those business models are levered?
It's a pricing power shock that we all need to navigate over the next several years and maybe beyond. Brian, it's good to see you. Thank you, sir.
Thank you.
Brian Levitt there of Invesco on this equity market. Equity futures doing just about okay. We're positive by 0.5% on the session. That is a session high. Let's get you an update on stories worldwide this morning with your Bloomberg Brief. Here's Vonnie Quinn. Hey, Vonnie.
Good morning, John. Thank you. Amazon shares trading lower in the pre-market. The company announcing its latest results and plans to spend $200 billion on data centers, chips and other equipment this year. CEO Andy Jassy says the money will predominantly go to the company's cloud unit, and most of that spending will be for AI workloads. Stellantis shares plunging Italian trading. The carmaker announcing it would take more than $26 billion in charges in a sweeping overhaul of its electric vehicle strategy. The write-downs follow similar moves at Ford and GM. Stellantis will incur the charges during the second half of the 2025 fiscal year. Anthropic is releasing a new version of its AI model designed to perform financial research and other workplace tasks. The company says Claude Opus 4.6 can scrutinize company data, regulatory filings, and market information to come up with detailed financial analyses. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Thanks for the update. More from Vonnie in about 30 minutes' time. Up next on the program, big tech's big wipeout.
It feels like DeepSeek and Liberation Day are happening at the same time. There is a sentiment overhang, just generally speaking, and some things are just being thrown out in conjunction with and might not be justified in our view.
A conversation up next with Sarah Kunst of Clio Capital, live from New York City this morning. Good morning. It's the bounce this morning. Let's see if it sticks. Equity futures up by 0.6% on the S&P 500. The Nasdaq up by 0.7%. The Russell up by more than 1 full percentage point in the last 24 hours. Some concerns about the real economy trade off the back of a handful of data points. It's worth passing through them. Check out the bond market. 2-year bond yields with a reset lower. We're down by 10 basis points just yesterday. This morning we're up by 347.90, still sub 350. Challenger job cuts plus jobless claims just pushing back against the enthusiasm that built after looking at the ISM manufacturing and services.
The idea was that even if you saw some sort of violent rotation in some of the tech trades, you did see the fundamental economy benefiting, if anything, from the capex boom that you're seeing. This really challenged it, and each data point was messy. And you could come out and you could explain why each one is inaccurate, and Stephanie Roth will do that later today. But if you look at them in aggregate, it paints a different picture than some sort of screaming stability in the U.S. economy.
Well, let's talk about another data point. $200 billion. How's that? $200 billion. The capex intentions of Amazon. Check out how the stock reacted. Down 7.7%. so far this morning. Call it 7.8. Just a bit of pushback this week from the equity market.
As Lisa would say, Amazon, the CEO woke up and said, Alphabet, hold my beer, because it was insane how much they were willing to spend on capital expenditures. What is so interesting is AWS, which is really important to cloud and this whole future for AI for Amazon, did really well. Double-digit percentage. They are doing really well, but the fact that they're just spending too much, people think it's not equal to how well AWS is doing.
Down by close to 8% of the pre-market, 205.20 on Amazon. Under surveillance this morning, big techs, big wipeout.
It feels like DeepSeek and Liberation Day are happening at the same time. There is a sentiment overhang, just generally speaking, and some things are just being thrown out in conjunction with, and might not be justified in our view. But it's very, very tricky, and you have to be very picky in terms of your exposure when you're thinking about going in, and that doesn't mean that sentiment's going to change overnight.
Here's the latest this morning. Amazon pledging to spend big on AI this year. Investors concerned it might not pay off. Tech stocks posting their biggest three-day rout since Liberation Day. Sarah Kunst of Clio Capital writing, just because the market goes down doesn't mean it's a buy the dip moment. Sarah joins us now for more. Sarah, welcome to the program. We've seen these convulsions across several pockets of the market now. Crypto, precious metals, software stocks. Is this the start of something bigger?
I think it's a continuation of something bigger. The economy is not where we want it to be. Consumer sentiment is not at an all-time high. The news coming out of America right now, politically, it's stressful. And so I think you're starting to see all of that converge with a level of capex spending that doesn't feel sustainable, because the reality is these data centers don't really create great jobs. You're going to need a lot of AI spend, and we don't know where that's going to come from to justify filling up these data centers with chips that do depreciate in value pretty rapidly. And so I think it's all kind of coming to a head at once, but it certainly is not just starting. This is a continuation.
Well, Sarah, let's talk about the data we've seen so far this week. So ISM manufacturing was really encouraging at the start of the week. Then we had 3 data points yesterday that were much less encouraging. The Challenger job cuts, jobless claims, and then a little bit later in the morning, job openings, vacancies fell back. How much weight should we put on yesterday compared to the ISMs at the start of the week?
I think that we are in a moment, unfortunately, where we have to really, really lean heavily on that private data. The reality is that the government has sort of a narrative that they want to push that might not be sort of aligned with the reality of what we're seeing on the ground. And so, I think AI is part of the slowdown in hiring. I don't think it's the whole story. I think that the overall weakening economy is a big part of that slowdown in hiring. We've all kind of forgotten about tariffs from last April, but they are having a big impact in terms of everything from tourism dollars to tariffs. The U.S. economy isn't what it once was, and that means that you're going to see less hiring and over time, more firing.
On a fundamental level, Sarah, that would challenge the broadening out trade that some people have been really leaning into, the rotation into everything else in the economy. On the other hand, people will say, but we're looking at $650 billion being spent by 4 big companies just this year alone. It's got to go somewhere. How can you pair these stories of a question of how much a U.S. market can broaden out in the face of relatively weak economic data, and then paired with these monster capex programs?
Yeah, so, I think a lot of the broadening out is going to happen outside of the U.S. We're seeing a lot of non-U.S. indexes go from strength to strength. We're seeing a lot of money that's interested in tech go right now into areas like South Korea that have, a lot of similar companies. And so we're seeing money go into the Samsungs of the world, into indexes like EWY. We're seeing that FTSE 100 has been having a great year. So I think people sort of remembered that America is not the entire global stock market. It just felt that way for a decade. And we're starting to see a lot of broadening out there. And then on the capex spend, at the end of the day, if these companies can't show how they're going to get paid for the data centers they're building and for the chips that they're buying, it's hard to see who really benefits besides NVIDIA.
So given what we've learned this week and given the sell-off in a number of these shares, what do you do with this? What would it take for you to come back into U.S. mega cap tech other than NVIDIA?
Yeah, it's really a case by case. There are names that I think are still screamingly overvalued, the Palantirs and Teslas of the world. The valuation, the stock price just does not reflect the revenue by orders of magnitude. Those aren't names that I would buy the dip on. And then there are other names that I think are getting beaten up a little bit. I love Alphabet. I've long thought that they will be kind of the ultimate AI winner. They are, certainly spending a lot on capex, but they also have loads of cash on the sidelines. They have a bunch of money coming in from their advertising. They can actually make money on Gemini, unlike a lot of the other platforms, because it's already baked into existing business models they have. And so I would look at that much differently than, an Oracle, where Oracle has a lot of different irons in the fire right now. And it's hard to say, hey, is there really the focus on any one thing that's going to drive, loads of revenue in the next couple of years?
Sarah, when you mention Gemini and you basically say, unlike others, you talk about OpenAI, because I remember in Christmas when you joined me, you were saying how they don't really have the runway potentially for the rest of the year, and they're going to go out and they're going to fundraise. But what does this moment actually mean for a company like OpenAI that plans to IPO?
I mean, if you take the tenor of Sam Altman's tweets, he seems like he is a very stressed out man right now. And for good reason. We all saw last weekend the sort of odd dance between him and Jensen around will they, won't they with this $100 billion investment round. There's not a ton of money that has come in. The competitors, the Anthropics of the world, Gemini, are doing a very good job. We see OpenAI shifting to business models that feel not a position of strength, right? Whether it's letting adults be adults or, bringing advertising into the model when that's not something that's really core to their strengths or historically to their business proposition. What we're not seeing is loads of enterprise revenue, despite being told for years that that's where they were going to make that money. And so, yeah, there's huge concerns about how OpenAI is going to be able to afford to pay Oracle in those round trip deals that we spent so much time talking about last year.
Sarah, you mentioned Anthropic. Let's finish on Anthropic. To what degree do you think that company right now is punching above its weight, making waves that maybe its market position doesn't actually justify?
I think that they are really focused on enterprise business. They're really focused on building, things like coding tools. Time will tell if that works or not. I sort of tune out that noise. They're not really a consumer company. And so, they love to kind of be a counterpoint to OpenAI, certainly to Elon Musk and Grok. And that works well for them in the press. It probably helps them fundraise from a different sort of customer. But at the end of the day, what I think they're going to be judged on in their current trajectory is, can they get enterprise? Can they get engineers to go into their work budgets and pay them for their coding tools? And if they can, that'll be a big win. We also don't know over time where Gemini is going to go in that space. If Gemini decides that they really want to take that business on head on, I think that could be really tough for Anthropic. But for now, they seem to be safe on that front.
Sarah, appreciate your thoughts. Have a good weekend. It's good to see you. Thank you. Sarah Kunz there of Clio Capital. On Amazon, check out the move in the pre-market. A big single name mover for us this morning, down by about 8%. Later on this morning, we'll catch up with Gil Luria of D.A. Davidson. He's got this to say this morning: losing the lead, downgrading the stock to neutral. AWS continues to compare unfavorably to Microsoft and especially Google Cloud. Falling behind also means Amazon has to accelerate investment beyond the $200 billion of capex. Amazon may not have a choice but to follow through with a $50 billion investment in OpenAI.
Which raises this question of where all this money is going to, and can OpenAI hold its weight? But they continue to say AWS accelerated by 24%. They posted a 24% gain in their cloud computing unit, whereas Google's Azure, the cloud unit, posted a 48% gain. So they're growing faster, albeit not nearly enough for the market, because the market wants much bigger gains than that. We'll
catch up with Gil at about 8:15 Eastern Time, a little bit later this morning, a few hours away, so look out for that. Coming up on the programme, we'll catch up with Bloomberg's Tyler Kendall as Treasury Secretary Scott Bessent spars with senators on Capitol Hill. Plus, Yahira has your morning movers. Stellantis plunging 24% as it reverses course on its EV strategy. Some big numbers, some bad numbers coming out of that company. That story up next. Equities bouncing back. Here's equity futures for you, up 0.5% on the S&P 500 following a 3-day slide, the biggest 3-day drop going back to November. Compare the S&P 500 to the equal weight S&P. The S&P is down about 2% this week. The equal weight is actually higher. The pain concentrated in places like the Nasdaq 100. The Nasdaq heading for its worst week going back to Liberation Day last April. Switch up the board and get to the bond market. Bond yields at the front end of the curve, lower by 10 basis points in yesterday's session following some weaker than expected data. 347.69 this morning, still close to the lows of the year at the front end of the curve. But check out this in the FX market. This is the story for me not talked about enough. The dollar is on course for its best week of the year, which speaks to just how inversely correlated it was with risk appetite. Best week of the year for the US dollar as the markets begin to sink. This wasn't about debasement. It wasn't about sell America. It was about risk appetite.
Well, it seemed like people, when they did become risk averse, then went back into the dollar. I will note, all the trades that are doing the best are some of the ones that were beaten up, particularly at the end of last year. So it also feels like all of the consensus trades at the beginning of this year got violently reversed, and that's what we're seeing. And the dollar is part of that. And so the Sell America trade coming under question.
It's seen it cascade through financial markets over the past few weeks. Lots of single names out there, including a big move for Amazon and Stellantis. Let's get you more. 3 hours away from the cash open with your morning movers. Here's Yahara. Hey, Yahara.
Exactly, John. Amazon is the latest company getting punished for spending big. Shares are falling 8% in the pre-market as it pours $200 billion into AI infrastructure. It's a move that CEO Andy Jassy insists is necessary, saying that at AWS they are monetizing capacity as fast as they can build it. Still, investors are concerned since the spending is already projected to hit the bottom line. Amazon's forecast for operating income in the current quarter did come in below estimates. Meanwhile, that is creating some winners, and it is in the chip space. We are seeing NVIDIA, AMD, and Broadcom all higher this morning, just as we saw when we got Alphabet's massive capex number just this week. But we'll see if they're able to sustain this momentum, because yesterday only Broadcom ended in the green, and only by slightly. I will say NVIDIA is outperforming the Mag 7 this morning, up 3% in the pre-market. And we end on Stellantis. Shares are plunging here, down nearly 25%, as the automaker said it will take a $26 billion hit as it scales back its EV ambitions. Stellantis admitting that it bet too aggressively on EV demand that just didn't show up. It joins the likes of Ford and General Motors, which also took multi-billion-dollar write-downs for the same reason. John.
Yahara, thank you. Painful. And it's been a long time coming. The kitchen sink finally coming from that company, and maybe there's more work to do. As for Broadcom, I'm pleased that Yahara brought that stock up. It's amazing they're in this situation this week where a handful of tech companies have come out and said they're going to spend $650 billion this year. And on the week, Broadcom is lower by 6%.
I saw a number of analyst notes over the overnight actually pointing to Avco in particular and saying, look, they should be doing a lot better because ultimately they will be a beneficiary. People don't have a sense of where this money is going to go. Otherwise, you would imagine all the semiconductor stocks would absolutely be ripping, because $650 billion is a lot of money. I spent way too much time last night trying to calculate what you could buy for $650 billion. I came up with some really creative things.
What did you come up with?
Well, I'm just thinking, to power New York City costs about $15 billion a year. So how many cities would you have to finance? How many nuclear power plants? Maybe $15 billion. What about a spaceship that goes up to space and tries to create some of the potential
data centers
in space? I mean, it just starts getting comical when you start looking at how do you spend this money this quickly in this kind of scale.
I was listening to Guy Johnson earlier on this morning. The German federal budget for the year ahead. How about that? I mean, that's insane. That's the German federal budget.
So this is, you start to wrap your head around this and you think, okay, well, this should be a broadening out. But are they just competing with each other to sort of solidify market share, reserve things that aren't going to really come yet? Is this fictitious, or is this actually real? I mean, it's hard to get your head really to wrap around it.
Those numbers are big. On our radar this morning, Amazon adding to big tech spending spree. The retail and cloud giant joining Alphabet, Meta, Microsoft, and exceeding capex estimates. The four companies forecasting about $650 billion in AI spending this year. Elsewhere, Anthropic releasing a new version of its AI model specifically designed for financial research and office workflows. This coming just days after the company's expansion into legal services sent shockwaves through the software industry. And finally, Bitcoin finding a floor following its steepest single-day drop since the FTX collapse back in 2022. The world's largest cryptocurrency nearly falling below 60,000 for the first time in 16 months.
This is, to me, a really interesting story under the hood. How much is this part of the violent rotation that we're seeing right now? Bitcoin has lost more than $1 trillion since its peak in October 2025, about half of its value. A question here about how levered this fund, this money was, how much this comes with outflows that aren't coming back, and how much institutional investors are willing to go back into this market. That ultimately is the reason why people find it interesting that there is a floor here. Nonetheless, an existential question of what exactly the role is for Bitcoin at a time where it's not providing an offset to risk appetite.
No, it's trading like a risky asset. And you actually saw this come up this week with the Treasury Secretary. He was asked about this. Could Treasury have the authority to buy Bitcoin or other cryptocurrencies? He says, I don't as the Treasury Secretary, and I also don't as the chairman of FSOC. So basically, that whole idea that there were some Republicans actually pushing for that was dead.
Taking stock of things, it's kind of impressive that we've had these crash level moves in places like crypto, in places like precious metals and software stocks, and yet the index is still within 3% of all-time highs on the S&P 500. That's quite something.
What struck me is the lack of fear this week. We saw these really violent moves. We've seen semiconductors, we've seen software stocks down 30% from some of the highs over in October, and yet not a lot of fear. Some people come in, they say, this is way oversold, we're just waiting to find a place to go in, and it's because of that stability in the overall index. If the economy cracks, that changes. And that's the reason why yesterday was a different story.
Excited about the rotation until a couple of data points. We'll see if that's backed up over the next week. Let's turn to Washington. The Treasury Secretary, Scott Bessent, and the Democratic Senator, Elizabeth Warren, fighting it out on Capitol Hill.
Can you commit right here and now that Trump's Fed nominee, Kevin Warsh, will not be sued, will not be investigated by the Department of Justice if he doesn't cut interest rates exactly the way that Donald Trump wants?
That is up to the president. Can you commit that you will?
I'm sorry.
Can you commit that you will not hold up?
He won't be sued if he doesn't drop interest rates. If this was a joke, why not just say so?
It was a joke, and he made a joke about you too, Senator Warren.
Yes,
got a lot of laughs.
Bessent's comments coming after President Trump's joke about suing Fed Chair nominee Kevin Warsh over interest rates. Bloomberg's Tyler Kendall joins us now for more. Tyler, it looked like they were getting along just yesterday.
I mean, John, this was a rather contentious 2 days of hearings for Treasury Secretary Scott Bessent on Capitol Hill. This was perhaps the most heated exchange before the Senate Banking Committee between two people that often spar with each other. But the Treasury Secretary there saying that it would be up to President Trump about whether or not to sue or order the Department of Justice to investigate a potential Fed Chair Kevin Warsh if he does not drop rates, appearing not to rule out the potential. Now, as you mentioned, Warren's comments were referencing these reports from over the weekend that President Trump had joked about the possibility, though we should say he was asked directly about those comments afterwards by reporters on Air Force One. And the president said it was, quote, all comedy. But still, the Treasury Secretary's remarks came after an equally contentious hearing the day before in front of the House Financial Services Committee, where he declined to express a view about whether or not the president has the legal authority to remove a member of the Federal Reserve Board over policy disagreements, saying that ultimately he's not a lawyer and that's going to be a matter that has to be decided by the courts, though he did go on to say that he does believe that the Federal Reserve is an independent agency. But yesterday, the Fed pick was definitely front and center because this is the Senate Banking Committee. This is that gatekeeping committee that has the ability to block Kevin Warsh's nomination from proceeding to the full Senate floor. And as Senator Tom Tillis has said on this program numerous times, he's not going to let up on his threats to follow through in blocking that nominee until the legal matter against Fed Chair Jerome Powell is ultimately resolved. And John, I actually had the chance to catch up with Senator Tillis yesterday. He told me he's still not backing down on the threats. He told me that he's not in touch with the White House on them either at this point in time, that he has no idea when a potential confirmation hearing date is ultimately going to be set.
Tyler, great reporting yesterday. I also saw you spoke to Senator Kramer, who basically told you this is a waste of time. Do you think more pressure is building from Republicans in Congress on the White House and the DOJ to just drop this investigation altogether?
Right, Annmarie, we're starting to see almost a theme emerge, a common thread here, because Republicans are trying to thread the needle with going with President Trump's criticism against Jerome Powell, but they're against how it's ultimately manifested in this investigation against him. And I spoke to a lot of Republicans on the Senate Banking Committee, this key committee yesterday, that are saying while they disagree with Powell's stewardship of the Fed, they don't think that his testimony amounted to anything criminal, because we have to keep in mind the DOJ investigation, it isn't necessarily about those cost overruns. It is about whether or not Jerome Powell misled Congress about those cost overruns. I spoke to Kevin Cramer. I spoke to Cynthia Lummis. I spoke to Senator Mike Rounds, numerous who have told me that they don't think that what Jerome Powell said ultimately had criminal intent, and that they want to see this investigation wrapped up as quickly as possible. In fact, Annmarie, they say that actually shows why they are in favor of the president's policies, that they want to make sure that this investigation can go away so that they can get Kevin Warsh confirmed as quickly as possible.
That might take some time. Tyler, thank you. Tyler Kendall down in Washington, D.C. Let's park the legal issues and just focus on the data. Who do you think sounds better right now? Chairman Powell last week. Indicators suggest the conditions may be stabilizing in the labour market. Governor Chris Waller. There is considerable doubt about future employment growth and suggests that a substantial deterioration in the labour market is a significant risk. Based on the data in the last 24 hours, Governor Waller is sounding a lot better than Chairman Powell.
It feels like the market is one big applause audience, and it seemed like everyone with Jay Powell until yesterday, and then all of a sudden it was like, ooh, all right, we're going to head over here to what we hear from Chris Waller. Look, we don't know, and I think that ultimately is the real question, and there's a lot of disagreement on the Fed committee, which is the reason why it is so important to understand which Kevin Warsh we're getting, to understand what the leadership will be to guide what is otherwise an incredibly bifurcated committee.
More data next week. Payroll's Wednesday, I believe. February 11th. We'll be playing that game, so looking forward to it. Let's give you an update on stories worldwide this morning with your Bloomberg brief. Here's Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. Iran and the United States are negotiating to de-escalate tensions. Tehran saying the talks are the first stage of a longer diplomatic process. The U.S. delegation, led by Steve Witkoff, Iran's by its foreign minister. Toyota shares rising in Japanese trading. The company naming a new CEO, Kenta Kon, who will replace Koji Sato, who will become vice chairman in April. Kon served as Toyota's CFO as well as Akio Toyota's personal secretary for almost a decade. As CFO, he oversaw a period of record annual earnings and worked on next-gen cars and mobility technologies. Brevin Howard Asset Management's Minal Biswal is one of the world's most successful macro hedge fund managers, making billions of dollars. He hasn't had a single down year since he started managing money during the 2008 financial crisis. His fund has scored wins on everything from Korean interest rates to Asian currencies. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Appreciate it. Up next, a memory crunch.
The industry is now defined by the availability of memory that is going to be available for consumer electronics. And it creates, a sudden change in how OEMs look at of their build plan.
Up next, we'll catch up with Bloomberg's Mandeep Singh, live from New York City. You're watching Bloomberg TV. So here's the bounce. We're up by 0.6% on the S&P 500. Announced bounce on the Nasdaq as well. Likewise on the Russell. We'll see if it holds following the rout over the past 3 days. On the Russell 2000 higher by 1.26%. On the Nasdaq up by 0.75%. The numbers this week, absolutely humongous. Let's go through them company by company. Amazon 200 billion. Capex intentions over at Alphabet 185. Microsoft around 100. Meta 135. 650. In total. Absolutely ridiculous, Bramo, to try and get your head around.
And when you try to get your head around, the numbers seem even more ridiculous. But what really is getting people off guard is A, these numbers are growing much more quickly than the underlying revenues or profitability. And B, the fact that the numbers keep climbing so much far beyond analysts' expectations. So it raises a question. What is the end point? If you're tripling and doubling every single year, at what point do you start slowing your spending?
Mandeep Singh of Bloomberg Intelligence joins us now for more. Mandeep, imagine a number, then treble it. That's where I'm at right now. I just can't get my head around it all, Mandeep. How are these companies going to spend $650 billion this year? What on?
Yeah, look, I think everyone highlighted supply constraints and the fact that they didn't have enough capacity. Otherwise, they would have grown faster. So that sort of justifies the increase in capex. But you're right. I think the kind of increases we are seeing, probably Google is the only one who has earned it because their cloud revenue grew 48% and the infrastructure side actually was north of 50%. And they're doing it at, incremental margins of at least 30, 40% compared to an Amazon where the margins are going down. And yes, the growth did accelerate, but it's coming at the expense of margin. So to my mind, there is this rush going on in terms of securing supply at TSMC. And the bigger you are, I think the chances are you have a better shot at securing supply. But if you add up all the capex, which you have on the screen, TSMC cannot make as much in terms of, the needs that these companies are highlighting with their capex numbers. So they have to significantly ramp their own capex, the semi-cap equipment purchases to be able to service this kind of demand that they're seeing from the hyperscalers. So it'll be interesting to see what NVIDIA guides to, because NVIDIA hasn't moved. I mean, NVIDIA should be up, right, with all the capex increases. So there's something that at least limits right now in terms of what kind of upside NVIDIA may end up seeing because of these capex increases.
So Mandeep, here's my question for you. What do you think we hit first? Serious supply constraints or the limits of investor tolerance?
I think we are already seeing some sort of investor panic in terms of the free cash flow expectations for this year and beyond if this rate of capex continues. Because for public cloud businesses, the baseline capex was more around $40–50 billion. Now we are 3 to 4 times that. If that doesn't translate into revenue at the same pace, and yes, you have to invest upfront to bring the capacity online, but at some point you have to ask yourself, if I'm doing it, at the expense of margins and free cash flow, how long do I sustain? And that's where the questions were asked for Oracle. I mean, there was a pushback with Oracle because everything was tied to OpenAI. I don't know who are going to be Amazon's customers for the $200 billion in capex. Is it all inferencing, or is there a big training component? Because inferencing workloads are the only one that translate into cloud revenue. Training is more of a sunk cost. Yes, you're going to get a better model, but you're not going to be able to monetize it right away. So all these questions, I think, will become clearer as we go through probably the next 2-3 months.
Mandeep Singh, breaking it down. Thank you, sir. Bloomberg's Mandeep Singh. Alphabet might be the only company that's earned it. That's my takeaway from that conversation.
And this is something that others have pointed to as well, including Gil Luria, pointing to the 48% gain in their cloud computing business versus the 24% gain in Amazon, raising a question of, are the others just playing catch up?
So here's the take from Vivek Arya of Bank of America, expecting this capex boom to keep the party going for semiconductors, writing, despite a wall of worries, chip stocks are off to a solid start, marking the second best January in the past 20 years. Vivek joins us now for more. Vivek, welcome to the program. It is strange to see numbers this large and then look at Broadcom down 6% on the week. What explains that?
Yeah, good morning, John. I think first principles, we have to understand that the companies that we are talking about, right, these companies with billions or hundreds of millions of subscribers, they cannot grow 15, 20, 30% without investing in infrastructure. Investing in infrastructure is the only way that they are able to scale their offerings and provide a lot of value add to their subscribers. Because look, the number of subscribers are not growing 20 or 30% for a Meta or others. I mean, it already has 3 billion subscribers. So how does somebody like a Meta grow 30%? It's by extracting more value. So that's point number one, that you need to invest to extract more value. And AI is that intelligence that helps you extract that value. Now, in terms of what we have seen so far from semis this year, it's kind of a tale of two cities. We have seen phenomenal gains from semi-cap equipment, from memory, from optics, from the analog names. I think we could have the first $1 trillion of sales in semi-caps, in semiconductor sales. But the larger names, the NVIDIAs, the Broadcoms, the AMDs, have not participated yet because, I mean, they're not just great semiconductor companies. They also happen to be part of the mega cap sector, which is under a lot of pressure from rotation. But we think fundamentals are strong. You know, valuations are very compelling. So we think it's just a matter of time before the mega caps catch up also.
Vivek, how much more attractive do you think that NVIDIA and Broadcom and AMD are, because they've sold off and because they're getting this infusion of massive capex spending from the other mega caps?
Sure. I think part of this is a market call as well. that these companies are phenomenal execution machines. They are phenomenal growth machines, but they are also exposed to the daily headline noise and narratives, whether it's around OpenAI and funding, whether it's about the relationship between US and China. And to be fair, this isn't the first time we are seeing this. Remember, last year, the SOX index was up over 40%. Both these stocks did extremely well, despite a year where we started with DeepSeek, then we went to Liberation Day, and then we had so many arrows thrown at them. So these stocks are volatile. There are periods when they are in the background. But as we just discussed, the fundamentals are exceptionally strong, and these companies are the S&P 500 index is trading at 1.5 to 2 times earnings growth, and these stocks are trading below 1 times earnings growth. So in our book, that's extremely compelling.
As I was lost in rabbit holes of trying to figure out how to spend $650 billion last night, I was thinking, what's the constraint on pricing power for the likes of NVIDIA? I mean, if everybody wants their chips, or TSMC for that matter, if this is basically locking in capacity going forward, why can't they just jack up the prices? Why can't they double them? Why can't they triple them? I mean, what is the limit that really holds them back?
Sure. See, ultimately, they are selling to a group of customers who are extremely sophisticated, who do have other options, and who have to make sure that the price performance matches the offerings they are able to sell to their end customers. And if I look at generation to generation of, let's take NVIDIA's, Hopper to Blackwell generation, pricing probably went up 30 to 40%, but the performance went up anywhere between 2 to 4 times, right, generation on generation. So what we are getting is multiple factors of performance improvement for 20 to 40% increase in price. But no, the answer to your question is that, yes, these companies have great pricing power. I mean, look, NVIDIA has, 70, 75% gross margins. But at the same time, they have to realize that every new generation of product they put out, there has to be a more dollars of performance per unit price, because there is not just inflation in chips, there's also inflation in procurement of land and power and shell. In our book, actually, those are probably bigger constraints than the chips itself in the rollout. And I think the good thing is with those constraints, it might actually add a lot more discipline into this rollout of AI services.
Vivek, I just want to finish on investor tolerance. I think that's an important topic to end the week with. These companies, these chip players that you cover, are only going to be as rich as their biggest customers. And the spend from their biggest customers rests on the investor tolerance of the investors in those companies. Are we starting to see some real pushback this week that might constrain their ability to spend and ramp up spending in the years ahead?
Sure. What I will also say, John, is that spending is not always offensive in nature, right? You don't always spend to grow. Sometimes you spend to protect your turf also. So, without picking a specific, customer name, imagine, if you have a search empire or an e-commerce empire, right, or a social empire, right, you are the largest player, but now you see a group of these disruptive private companies after you. And remember, these companies were all private when they started, and they disrupted somebody else's business model. So now you have to say, what can I do to ensure that I not only grow at an acceptable pace, that I also protect my empire. And then importantly, I also grab all the eyeballs. I have all the customer relationships in place, and it just takes upfront spending to do that. And in the past, what did we have? We had a lot of cash sitting on their balance sheets doing nothing. And now that cash is being put to productive use, in my view.
Hey, Vivek, appreciate your time. Thanks for jumping on for us. Vivek Arya there of Bank of America on the chip names that should benefit from some massive spending from a handful of companies. Up next, we'll catch up with Priya Misra of JP Morgan, Jeanette Lowe of Stratega, Stefan Slavinsky of BNP Paribas, and Michael Collins of PGIM Fixed Income. The second hour of Bloomberg Surveillance, up next.
It's a strong macro backdrop, not just in the US.
This is still a hottish economy.
I think it is a loosening labor market, lots of statistical issues.
There's a lot of difficulty in reading, I think, the trends.
The data has just held up just so well. We think the data will tell the story.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now. Your scores look like this. Has a 3% move ever felt so bad? Equity futures on the S&P 500 up by 0.6, on the Nasdaq up by 0.8. A feature of the market this week To see that move right there and this move right here, Amazon in the pre-market getting absolutely hammered after a $200 billion capex spend for the year ahead, down 7%. To see that stock down 7% and the Nasdaq still higher is kind of the story of the week so far.
Liz Ann Saunders had a great quote yesterday where she said, rotation is the new momentum. And ultimately, you're seeing violent rotations underneath the surface. It is notable that we're talking about $650 billion of capex spending. One newspaper said that Amazon, Google, and Microsoft are set to lose a combined $900 billion of market capitalization since their earnings reports. These numbers are almost fictitious at this point. It's hard to get your head around them. The fact that the market has continued to chug along is predicated on the idea that the spending is going to go somewhere and that the economy is solid. If that gets challenged, this story changes.
The equal weight just short of an all-time high. The equal weight this week is actually up on the week, even with these kind of moves that we've seen. 10% on Microsoft, 8% on Amazon.
Well, so it's under the surface where all this is going on. But under the surface, it's absolutely brutal, especially given the fact that everyone has been looking at these names to continue to carry the equity market. I cannot wait to talk to Gil Loria, because when he talks about Amazon, he's saying the negative reactions result of bigger increases to capex than to AWS revenue. AWS had actually pretty good revenue, but it wasn't good enough. And what do we just hear from Vivek? A lot of this spending may be individuals trying to protect the perks that they have right now.
Always find that moves like this bring the best out of Wall Street. Great quote came from Michael Kantrowitz over at Piper Sandler with this to say, I think we're seeing the unwind of a 3-year economic and market bifurcation that's beginning to broaden out.
I love that, especially given the fact that yesterday it was a jobless recovery. It was the jobless expansion. The problem with this is that you need the real economy to participate with some sort of gains if you do get this sort of right sizing of the economic benefits that we've seen over the past couple of years. And yesterday, the trifecta of what we got with challenger job cuts, then what we got with jobless claims, and then what we got with the JOLTS numbers raised questions about just how durable that story is. So right now, the ultimate question is, as we get this violent rotation, do we get the economic boom that so many people were hoping for? Does that $650 billion go to things that we can relate to, or just sort of fibers that go up into space?
If last year tech capex was more than 40%, roughly 40% of GDP growth in America, what is it going to be this year at $650 billion just from those companies?
People are looking at that as being something like 2% of the U.S. GDP. But the truth is, we have no idea where this is going. We don't know if this is land. We don't know if this is promises to TSMC to get them flowers when they give them their chip orders. I mean, how much do we have an understanding of exactly how they're going to spend this in a way that actually will be expansionary?
A lot will go to chip companies. Broadcom, Nvidia, trading positive in the pre-market by 3 to 4% so far. Equities up by 0.7 on the S&P 500. Coming up this hour, we'll catch up with Priya Misra of JP Morgan as Wall Street looks to find a floor. Stefan Slavinsky of BNP Paribas as software stocks shed billions in value. And Michael Collins of Peach in fixed income as weak labour data weighs on investors. We begin this hour with stocks finding a firmer footing after a 3-day tech rout. Priya Misra of JP Morgan writing the market is trying to figure out the AI winners and the losers. Priya joins us now for more. Priya, good morning.
Morning.
Bond market's the clear winner this week, surely.
Indeed. And that diversification aspect, that fixed income, that treasuries, that duration. You know, I think a lot of people sort of stay in the front end. The front end doesn't give you that much. It's really the 5-year, 10-year. So we've been saying this is the revenge of diversification. You know, it was not very popular to own duration, but we've been thinking 375 to 4.25 is sort of that 10-year range. We went above it, sell America, you know, just a lot of supply, the tax refunds, all of that sort of got us above that. We think that's an opportunity, you know, but ultimately I think we're in this point where we don't know. You know, remember when sort of AI capex was all that the market was looking for last year? I think the market's pushing back. The market wants to see there's a bit of a show me. Show me the productive users of that AI capex. Show me how people are using it. I mean, we're using it to sort of reduce the no joy work, as you know, we put it. But is that going to displace us? Is that going to just disrupt us? I think that's what the market's trying to figure out. We're not going to get answers very quickly. This is such a generational transformation. We're going to live in this bumpy ride. And this is why I would say, you know, sort of watch positioning, look at fundamentals, and then make sure that you own those hedges. As the market starts, if the market starts to say that maybe this is overdone, that's when you're going to need those hedges.
You threw some mud at the Sell America trade. At least that was how I interpreted it. So let's get into that a little bit. This was an important stress test over the past few days. How important is it to see that the dollar and bonds is still inversely correlated with risk appetite?
So on bonds, I would say we have a lot more faith there. The dollar still looks a little overvalued. Now, it was very heartening what we saw yesterday, but on rates, so where does that correlation or negative correlation come from? It comes from the Fed reaction function. I think that's still very much there. I mean, we have a divided Fed. Chair Powell said that there's no urgency. But you see a rise in the unemployment rate, or you see a clear sign that we're moving from a low higher, low fire to low higher pickup in fire or high fire, you're going to see the Fed react aggressively. This is not a shy Fed. Irrespective of the chair, I think the divisions will actually go away. I mean, the other thing is, it was AI inflationary or disinflationary? I think that's been another debate in the macro world. I think I'm looking at, as a macro person, I'm looking at price action, and the market's telling you it's disinflationary. Now, we have to see it in the data, and I think we'll see it later half of this year. As inflation starts to get low, I think the Fed's telling you they might cut. So on your point around that diversification, I think bonds tell you the Fed response. With the dollar, we still have to see. There's a lot of value globally. We're seeing cyclical pickup. Look at ISM. So there still may be some pockets of weakness in the dollar. But I think, price action like yesterday does tell you this is why you should have a diversified portfolio. And on the sell America, I mean, we're not seeing it in the credit market. I think that would be one that I would look at. The equity market's so much about AI and software. Look at the credit market, and that's where there's incredible calm, as we've had a lot of supply.
There's a lot to unpack there. You just start talking about how a lot of the bond market is trading on the idea of the Fed reaction function. Isn't the Fed reaction function pointing to a pretty negative outcome for the U.S. economy right now, that they're cutting rates for the wrong reasons, which is a slowdown in the labor market, not because of the disinflationary boom from artificial intelligence?
So great point. I think in 2024, the rate cuts were about the labor market. In 25, it was more inflation. And I think we're going to have to figure out these rate cuts. Is it what Kevin Walsh has talked about, this productivity boom with the supply sides kicking in, and the Fed needs to cut? That's actually good news for risk assets. I don't know if we see it in the data. Productivity is high, but it's like it's a residual. So I don't know if I buy that. If it is a rise in the unemployment rate, I think the market might cheer that we get lower rates. I would be careful, because if the labor market's turning, it tends to trend, and then rate cuts will take a while. We're going to have to look at fiscal. Do we get more than just the tax refund? So I see your point. Rate cuts, lower rates for the wrong reason is negative for risk assets. But I think if the Fed is aggressive, if we see a small rise in the unemployment rate and the Fed starts to cut aggressively, I think the market might cheer, as it has for the last 2 years. It's how reactive, how aggressive the Fed will be that can sort of impact risk assets.
You said something else, which is that you could see that foreign institutional investors are still going into U.S. credit. They're still liking the U.S. Financing mechanism for, guess what, some of these big tech companies, which are accounting for a greater and greater proportion of the overall broad investment grade index. Does that worry you? Do you see anyone pulling back and saying, hold on a second, what exactly are we financing?
So, I've joked before that when you call people to the bond party, everyone gets a little nervous. And I think there was some of that late last year. We're going to see it again. How much of this capex is going to be financed by the bond market? And how much is going to come from elsewhere? I think the market is the ultimate disciplining factor. And we saw this with Oracle. There was concern, $50 billion in bonds. Well, I'm going to want a little bit more concession there. But they actually issued only half of that. And then you look at the book. So I think when we think about fixed income, people have been very underweight fixed income. When they think of fixed income, they sometimes think about the front end, because they say, well, there's no we don't know about diversification, and there's not a lot of income. Well, guess what? You're getting 5.5% in high quality fixed income. And this is where I will say, let's look at the companies. We still think these companies, whether it's the software names, they're still tight. So we're not saying that that's very cheap. That's going to widen. I think you look at the fundamentals, look at leverage ratio, look at cash flow. There's still a lot of good value. And I think people look at fundamentals, they see that 5.5%, 6% all in yield, and they buy. So we've still seen, look at the order books, there's going to be supply. As long as these companies don't overdo it and really swamp the bond market, I think we're seeing that demand. Spreads might be a little wider. There's more dispersion, actually. That's, I think this is why we're seeing it in the high yield market. Look at loans versus bonds. I think we're going to see it in the investment grade market as all of this $650 billion starts to get financed. And if somebody overdoes it in the bond market, they're going to cheapen. And this is why active management, fundamentals, We're all over our research analysts every single day, multiple times a day. I think this is the time when, I don't know, it's a bond market, stock picker equivalent time, because there's going to be a lot of supply that's going to come in. We're going to have to pick and choose what we're overweight.
Priya, you mentioned the fiscal impulse. Is any of that inflationary when it comes to one big beautiful bill that you'd be worried about?
So a lot of what was in the one big beautiful bill was extension of the tax cut. So I don't see that as being inflationary. I think there's this talk of tariff, the tax refunds. I think if it goes to the upper part of that K, it's going to get saved. It's going to just expand the K. Where's that income distribution of the tax refunds? There may be some sort of sugar high, but that's for a couple of months. That's for the first, maybe second quarter, if it's not already been spent. So I don't see a whole lot in the one big beautiful bill. Now, if you get tariff dividends, you get something additional. I'm not sure how they get that done, but I think additional fiscal stimulus can be inflationary, not what we're seeing from just the one big beautiful bill.
Should we finish on the yield curve? 2s versus 10s, just off the steepest level since January 2022. What do you think that's sniffing out?
I think the steepening in the curve, particularly what we saw yesterday, is the market pricing more cuts in the front end and sort of keeping the long end here. It's also a global story. I mean, we have the Japanese election on Sunday, along with the Super Bowl, so we'll be watching that.
That is our Super Bowl, Priya. You know that.
True.
Continue, please.
We'll be seeing if global bond yields, that term premium increase in the long end. I think that's well priced. Let's hope for not a lot. I would prefer duration over the curve, but I think the curve is telling you that if the Fed's going to cut, it's likely to impact the front end much more. But I think owning the 5-year, if you don't have a strong view on the Japanese election or how quickly the Fed's going to cut rates, I think duration feels like better risk reward given current levels.
I think there are stronger views on a Japanese election around this table than there are on the Super Bowl, but we'll leave that there. Priya, thank you. Priya Misra of JP Morgan. In the bond market, 10s in a moment, 420, 2s at 348.
I'm just thinking, if Bad Bunny's playing at the halftime show for the Super Bowl,
Takeichi's got us covered, right?
Is it going to be Taylor Swift? Is it going to be, or you think Takeichi's going to do it personally? Wow. Oh, yeah, because she was in a band, so she can actually have her own halftime show.
Where I was going with this.
Okay, well, that's so good. All right, sorry,
right.
I blew it.
Let's move on. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Vonnie Quinn. Hey, Vonnie.
Hey, John, thank you. The search for Today show co-host Savannah Guthrie's mother is entering its 6th day. The FBI announcing a $50,000 reward for information leading to Nancy Guthrie's recovery or the arrest and conviction of people involved in her disappearance. The Pima County Sheriff's Department says neither a suspect nor person of interest has been identified in the case. President Donald Trump launching a new website to apparently help Americans buy select medicines at a discount. The president saying more than 40 medications will be available through the site, including Novo Nordisk's Ozempic and Wegovy for $199, as well as EMD Serono's fertility treatment. OpenAI is rolling out a new platform called Frontier, designed to help companies deploy AI agents more easily. The company says Frontier aims to simplify how businesses roll out AI and accelerate adoption among corporate customers. The tool will also allow firms to integrate AI agents from rival firms, including Anthropic. And that is your Bloomberg Brief. John.
Vonnie, thank you. More from Vonnie in about 30 minutes. Up next on the programme, casting doubt on the Powell probe.
Whether he had criminal intent is not my decision.
Was it criminal? I don't think so.
So I would like to see the investigation wrapped up quickly.
Until the investigation is done, I will oppose any board confirmation.
Up next on the programme, we'll catch up with Jeanette Lowe of Strategas, live from New York City this morning. Good morning. Single name price action has been absolutely massive. Amazon down by 7% in the pre-market, intended to spend $200 billion in capex for the year ahead, punished because it's not putting up the same growth numbers that we've seen out of a company like Alphabet. But a feature of the week is this right here, that you can have single name moves of this size, move this much, and the damage is limited at the index level to this. The S&P 500 is higher on the session by 0.5%. And even when it's traded lower, we're down like by, 2% on the week? We're within 3% of all-time highs on the S&P 500. This rotation beneath, I know a lot of people are talking about the same thing, but I don't think you can overstate the importance of it, given the price action we've seen so far over the past few days.
And the magnitude of the rotation away from certain areas. You talk about the software stocks that are down some 30% from the highs that they had last October. You look at Bitcoin, that is down about 50% from its high in October. It is violent, but it is a rotation. It isn't necessarily Armageddon. That said, a real question of how much this is predicated on the growth of the economy and how much this is going to be predicated on the use case for some of this incredible capex spend.
The price action in the last 24 hours had a different flavour. It wasn't just about software stocks. It was also about the real economy and maybe just opening the door just slightly to a conversation about interest rate reductions. Under surveillance this morning, casting doubt on the Powell probe.
He obviously didn't tell the truth about the renovations. Whether he had criminal intent is not my decision.
Was it criminal? I don't think so.
I was at the hearing where some have said Chairman Powell perjured himself. And I didn't hear anything that could be remotely considered to be perjury. So I would like to see the investigation wrapped up quickly.
Until the investigation is done, I will oppose any board confirmation.
So here's the latest this morning. Republican senators voicing skepticism on the DOJ's investigation of Fed Chair Jay Powell as President Trump says D.C.'s U.S. attorney will take it to the end. Bloomberg's Tyler Kendall joins us now for more. Tyler, that's some real Republican pushback through this week.
Right, exactly, John. I mean, numerous Senate Republicans told me that they increasingly view this Department of Justice's investigation into Fed Chair Jerome Powell as this unnecessary roadblock that could stall Kevin Warsh's nomination, which they broadly support. I spoke to a lot of members of the key Senate Banking Committee who told me while they broadly agree with President Trump's criticism of Fed Chair Jerome Powell, they don't agree with the investigation that's resulted, because we have to keep in mind the nuance here is that the DOJ's probe is looking into allegations that Powell misled Congress about the Fed's renovations to its headquarters here in Washington. The probe isn't just about the cost overruns themselves. It is about that testimony that Powell gave to the Senate Banking Committee. So all of those members that you just heard from actually heard from Powell in real time when it comes to the testimony in question. And they're saying that they don't think that he had that criminal intent and that there's anything here for the DOJ to investigate. Now, to be sure, a lot of them still told me their criticism of the Fed chair, but they actually say that it is their support of President Trump's agenda that actually makes it make sense for them to wrap up this probe as quickly as possible. Because as you well know, and you just heard from Senator Tom Tillis there, he says he's going to block any nomination until that legal matter is resolved. And they want to see Kevin Warsh confirmed as quickly as possible. John, perhaps the staunchest criticism of this probe came from a really staunch ally of this White House, Kevin Cramer of North Dakota. He told me that he thinks that this is a distraction and a waste of time. The question now becomes, what does the DOJ do? Because, as you said, President Trump says he wants to see this investigation taken all the way to the end.
Tyler Kendall, thank you. Joining us now to continue the conversation, Jeanette Lowe of Strategas. Jeanette, if Republican senators, in Tyler's words, are calling this a waste of time, how much more time are they going to waste?
Yeah, it's a great question. I mean, I think that, as Tyler pointed out, this is literally something that the Republican senators are now thinking we need to get this investigation concluded. We need to kind of clear Powell, which is something that Tom Tillis is looking for, because they do need his vote to move Kevin Warsh through the Senate Banking Committee. And they would like Kevin Warsh to be confirmed before Powell's term ends on May 15th. So I do think you'll probably start to see some movement there to get this done, which I think especially what we've seen coming from various senators yesterday was really important to see that they really do also want to get this moving somewhere a little bit more quickly, because this is an important distraction potentially for getting Kevin Warsh ultimately on the Fed.
Movement from who? Is it the DOJ to wrap it up, or for Fed to actually also comply and send the information that the DOJ is asking about in terms of the renovations?
Yes, I mean, I think that's a little bit to be determined, right? There could be that maybe the Fed just hasn't responded to the questions yet. Maybe they just need to respond to the questions, and then the DOJ will kind of finalize the investigation and say that there's no wrongdoing here. Maybe it's some other form that needs to take, but there probably is a way that this could be handled relatively quickly so that we can actually move on from this. And then actually the Senate Banking Committee can bring in Kevin Warsh and actually have his confirmation hearing.
You sound hopeful of a quick timeline. If we don't, do you just expect Powell to be chair until how long?
Yeah, I mean, this is a really important question. And obviously there is discussions about what happens if, there is no one confirmed to be the Fed chair when Powell's term ends. What happens? Does it become the vice chair? If there's no vice chair, is there a possibility that the vice chair could resign? Those are all things. And then ultimately the board could reappoint Powell. The other big question, obviously, is does Powell stay after his term expires? I think this is a really important question for what Kevin Warsh would like to do at the Fed. Obviously, whether or not the president can get another appointee onto the board of governors. They do want to engage in financial deregulation. Vice Chair Bowman has a proposal that she may announce as quickly as this month. So they do need to actually move forward on that. That's going to be key to Warsh's trying to reduce the size of the Fed balance sheet. But they also need a majority of the Fed board members to vote for the most aggressive plan they could have. Right now, if Powell remains on the Fed, that could limit the ability for them to actually get to that majority. So his staying on or not is going to be a key question moving forward as to how things actually proceed, and also what might happen if there is no Fed chair confirmed before his term expires.
While we wait for the next edition of Bachelor in Purgatory, Jeanette, I am curious going forward. It is a midterm election year, and we are going to expect a number of proposals to try to cater to how people feel, which isn't great and has to do with the affordability issues. We saw yesterday President Trump coming out with Trump RX, trying to lower costs for prescription drugs. What else do you think is in the works for this year as the midterm elections get closer?
Yeah, so I do think this is going to be a key focus for the midterm elections. You saw it be a key focus for the November 2025 elections to focus on this issue of affordability. And Trump has definitely picked up the mantle of this quite a bit more in the past few weeks. So obviously we had the prescription drug price proposal come out yesterday. We do think they're going to try to do things on housing. Some of that would be related to, again, whether or not, not even necessarily trying to do legislation or anything of that nature, but maybe what happens with the Fed and what happens with the Treasury. Those can be important pieces for the housing market. The other big thing, obviously, is there are these large tax refunds that are going to come out. The tax refund just started last week. We'll definitely start to see more of those come out. That will be very beneficial for consumers. Will it be enough before the election? They probably don't think so. They'll probably try to come up with some other ideas. Presidents tend to be more populist in the second term of their presidency because voters are a little bit sour on how things are going. So we could definitely see more announcements. We'll be looking to the State of the Union to see if stuff comes out there. But I don't think that there's a lot more that is actually going to get enacted. We don't think that there are going to be tariff refunds that are going to come out because you would need Congress to do that. But you might see them try to move things like permitting reform and things of that nature. But I think the president will continue to talk about it, but we don't see a lot of movement for more proposals to come forward.
Jeanette, thank you. Jeanette Lowe there at Strategas. Those final few points, really, really important. The three tailwinds for the economy this year, the tax refunds, the monetary policy stimulus already in the pipeline, and then $650 billion worth of spending from just 4 companies. And if you're an advisor to the president and you sit there and you tell him that, how patient can he be? How much can he rely on those 3 things going into the midterms?
Well, how patient can one person or how patient can President Trump? Right now, it doesn't seem like anyone's particularly patient just because the polls are reflecting a serious concern. And I have to say, the $650 billion, when I pay my electricity bill, am I competing with Amazon? I'm serious. This is actually a serious question.
I'm really glad you brought this up because the Michigan Attorney General is actually going back to the utility, saying these data centers, I don't want to go ahead with this just yet. I don't trust these companies. She literally called them untrustworthy when it comes to OpenAI and Oracle.
The pushback is real. It's not a risk. It's happening. Coming up next on the program, Stefan Slavinsky of BNP Paribas on the sell-off in software stocks. So deep breath. Here's the bounce. 3 crazy days. Equity futures on the S&P up by 0.5%, following the biggest 3-day decline going back to November. Over that period, down by 2.55% on the S&P 500. Yesterday, a bit of a different character to things, though, and we've talked a lot about that so far this morning. It wasn't just about tech stocks. It was across the board. Financials, energy, consumer discretionary, only 2 major sectors in positive territory at the close yesterday, utilities and consumer staples. And that was off the back of weaker than expected economic data. So switch at the board and let's talk about this. Sell America. We've all read that headline a few times, haven't we, over the past few weeks? Was it a Sell America trade, or was it just consistent with the pickup in global risk appetite? And once that reversed, Did the money come back to bonds? Did it come back to the US dollar? That's what we saw yesterday. 2-year bond yields down 10 basis points. This morning up by 3. Still sub 350 at 348. And in the FX market, worth noting, the dollar is on course for its best week of the year so far, which would speak to the idea that this wasn't about sell America. It was about a pickup in risk appetite globally with an AI twist. And when that unwound, the money went back into the US dollar.
There certainly was a reversion of a lot of the trades that had gotten popular earlier this year. With respect to the bond market, it seems like the Fed very much in focus and the possibility that they could cut rates more significantly. With the dollar, a real question about the U.S. economy and how much it can grow despite some of the disruption that you're seeing under the hood. That, I think, is going to be what you have to watch going forward to see whether this is sustainable.
Bond investors, the only people popping champagne this week. The bonds work, and they've been trying to tell people that for a while.
If I ran a utility, I'd be popping champagne, too, because I could charge whatever I wanted for electricity. I mean, there are some people who are popping champagne or maybe a box of Lay's, because ultimately that also is gaining some today. But we're looking right now at a market that is incredibly bifurcated, and people are seeing a disinflationary boom under the surface, and that, I think, is benefiting fixed income.
It was an important stress test for the bond market this week, at least, and let's see if that correlation, that inverse correlation with risk, sticks for the year ahead. Yields higher by 2 basis points on 10s, 420. Plenty of big movers out there, including Amazon. Let's get to your morning movers with Yahira. Hey, Yahira.
Hi, John. Big Tech's $650 billion spending spree is helping to lift the names part of that build-out, the chip makers. We are seeing NVIDIA, AMD, and Broadcom all higher in the pre-market, though we'll see if we're able to sustain this momentum. As you guys were talking about champagne, this momentum keeps fizzling out since only Broadcom yesterday managed to end the day in the green, and only by slightly. And as you said, John, all these stocks down on the week. Meanwhile, moving on to Stellantis, where shares are plunging in the pre-market, down now nearly 28%, as the automaker says that it will take a $26 billion hit as it scales back its plans for EVs. Stellantis admitting that it bet too aggressively when it came to EV demand. That just didn't show up, so it's joining the likes of Ford and General Motors, taking multi-billion-dollar write-downs. And we end on shares of Hims and Hers. They are falling more than nearly 9% in the pre-market as it faces FDA scrutiny and a legal challenge from Novo Nordisk, stemming from its announcement this week that it will sell a cheaper, unapproved version of Novo's Wegovy pill, which is a drug still under U.S. patent. And yes, at one point, Hims was able to sell compounded versions of drugs since they were in short supply, but that no longer applies since Novo does have plenty of supply. So you're seeing Novo shares up 6% in the pre-market. John?
Yahira, thank you. More from Yahira in the next hour. Speaking of popping champagne, this headline just crossed the Bloomberg terminal. The bonus pool at Goldman, JP Morgan and Bank of America rising at least 10%. So some smiles out there, I'm sure.
Congratulations. You guys also get champagne along with your utility company that's going to be getting some of that bonus check. Look,
these weren't the people worried about paying their utility bill at the end of the month.
I would agree with that. And they probably are the people who also are benefiting from some of the IPOs that could come down the pike from the likes of OpenAI. Let's see what that looks like later this year. But clearly they've been doing well, and you have seen that war for talent really heating up on Wall Street.
The latest on bankers' pay there. On our radar this morning, Amazon shares dropping on plans to spend $200 billion this year on data centers, chips and other equipment. The move bringing total capex for the 4 largest US tech companies to about $650 billion this year. Elsewhere, Stellantis shares falling as the company announces $26 billion in charges to reverse course on EVs. The write-downs following similar moves by fellow car makers Ford, GM and Porsche. And finally, a clash on Capitol Hill. Treasury Secretary Scott Bessent and the Democratic Senator Elizabeth Warren sparring once again.
Can you commit right here and now that Trump's Fed nominee, Kevin Warsh, will not be sued, will not be investigated by the Department of Justice if he doesn't cut interest rates exactly the way that Donald Trump wants?
That is up to the president. Can you commit that you will?
I'm sorry.
Can you commit that you will not hold
up? He won't be sued if he doesn't drop interest rates. If this was a joke, why not just say so?
It was a joke, and he made a joke about you too, Senator Warren.
Yes,
got a lot of laughs.
President Trump joking about suing Kevin Warsh at a dinner in Washington last weekend. Bessent testifying yesterday that Warsh is highly qualified to lead the Fed.
All right. There's nothing that I can say that can actually be more entertaining than that. That's just clearly entertaining. It's kind of like my boys at the dinner table ragging on each other. I mean, that's what it sort of feels like. Whether we're moving toward any kind of clarity on what President Trump's interference or not will be with Kevin Warsh, whether we're moving toward clarity. Sorry to throw some cold water on this because it's very exciting, but I'm looking for the news here, and it's that they had a very exciting sparring match that they can both put on their social media accounts and look good.
And they both did. And then I went, chasing after what the joke was. I found out what the joke the president made about Elizabeth Warren, but the joke he did make about suing Kevin Warsh, he already told us on Air Force One reporters. He said, look, it was a roast, it was a comedy. And then he said to NBC News, if Kevin Warsh came in here and said I want to hike interest rates, no, he wouldn't have gotten the job. So we know where the president stands.
Don't bury the lead. What was the joke?
The joke was Warren got turned away from the alfalfa dinner because she didn't have a reservation. And it goes after what Trump always calls her Pocahontas, because when she ran, obviously a lot came out about how she said that she has heritage back to the Native Americans in America. So that was his joke about Elizabeth Warren. And then Besson said, look, it got a lot of laughs. He was trying to engage with her, but she was not having it.
He managed to make her smile, kind of, just about. OK, let's turn back to tech. A single Anthropic plugin providing even more fuel for the sell-off. The S&P 500 software index on track to wipe out $1 trillion in value since the rout began. Stefan Slawinski of BNP Paribas writing, should software companies show stabilization in their core businesses, investors may be willing to live with long-term uncertainty. For now, investors are saying, we'll believe it when we see it. Stefan joins us now for more. Stefan, good morning to you. Are you reassessing the multiple that these companies deserve?
Yeah, so at BNP Paribas this week, we've been helping investors trying to understand what's being priced into these stocks. It's difficult. When you're talking about technology disruption, obviously you're talking about a lack of visibility on long-term cash flows and long-term growth. We've looked at sort of reverse DCFs, and some of these stocks are already pricing in declining growth going forward. And when you look at free cash flow yields, most of the sector's already trading on kind of all-time lows in terms of free cash flow multiples here. So it's difficult, and I think that's the uncertainty that we're seeing. And so what we've seen this week really is a combination of one, uncertainty, really causing people to doubt their positions, and two is fatigue. It's been 3 years, Jonathan, and we're still getting every single week a whole slew of announcements around AI. And I think that leads to three, which is capitulation.
We've seen some of that in some stocks like Salesforce. Salesforce is down 28% so far year to date, Stefan. Do you think there are opportunities already opening up? And you mentioned your conversation with clients. Are you pointing them in the direction of certain names, and can you share them this morning?
Yeah, absolutely. There is a part of the market. We're starting to see long-only investors who are kind of dumping the sector, which is a problem, of course, because it takes longer to recover from that. But I think when you look within software, if you think that the capex pressure is overdone, then you look at a Microsoft. For the first time in 10 years, Jonathan, Microsoft is trading below an S&P 500 PE multiple. And so that's an opportunity for a company where people are worried about the capital expenditures. If you look at SaaS, as you just mentioned with Salesforce, you've got about a 9% free cash flow yield. You have no free cash flow risk. You have no capex risk. And you have arguably potentially two home run AI products in Data Cloud and Agentforce. So that's one that we would be looking at if you think the SaaS sell-off is overdone. And then if you look at the kind of throwing the baby out with the bathwater category, look at a Snowflake. These are companies that should benefit from AI. AI is actually causing an acceleration of moves to the cloud, what we've been seeing for a decade. And so someone like a Snowflake who actually benefits from that, is also seeing their stock heavily under pressure. And also that company already has a consumption-based business model. So there's no seat-based disruption risk.
Stefan, as we talk about numbers like $250 billion with just sort of a brush of the hand, is there power in scale? Is there power in numbers? Do you agree with Dan Ives that you're going to see some real consolidation in the software space?
I'm not sure how quickly consolidation is going to happen, but we certainly could over time. That's what we've seen in the past during periods of stress. That's what we've seen in the past during periods of transition, of new platforms. The problem is, of course, right now, a lot of the stocks that are under pressure for a reason. And I'm not sure the market would react well to some of the big players acquiring some of those businesses, even maybe if it's the right thing to be doing. I think what investors are looking for is managements and insiders to step up and start buying their own stock. I think that would really kind of instill some confidence rather than just telling investors the sell-off is overdone. maybe launching some corporate buybacks, management teams need to step up, insiders need to step up and show the confidence they have in the outlooks of their own businesses.
Stefan, given the scope of the losses, are you surprised at how orderly this process has been, how it hasn't come with broader market losses, and it hasn't come with a broader wave of existential fear?
Well, I think as you pointed out over the course of the show this morning, there are lots of cross currents. This isn't just about software. This isn't just about AI. There's lots happening within the market. We're seeing that impact different asset classes. I think for software, what investors are coming to the realization of is the only thing we know for sure is we're going to get more models, we're going to get more money, more infrastructure, and more uncertainty. So the one thing that we know is that we're going to have Grok come out with new models from XAI. We're going to have Meta come out with their models. They're going to have capabilities that maybe will spook people in other industries. And that's one of the challenges for investors is every week there's a new model that's strong in a new area that's going to spook some of the incumbents. We're going to get more money, as has been publicly reported. Anthropic, maybe $20 billion raise, OpenAI, $100 billion raise. XAI being bought by SpaceX gives them cash flows now to invest more. That's going into the infrastructure. So $700 billion of capex now this year from the big five. And all of that's just going to lead to continued uncertainty. And so I think investors are growing fatigued of that. They don't see an end in sight. Maybe some of them are looking to pick up names, but we're not seeing a lot of it.
Stefan, when you say that some of these management companies should step in, basically they should put the money where their mouth is. Who do you think would be right to do that and do some buybacks?
All of them, any of them. I think in terms of the buybacks, we're seeing that already at the corporate level. A company like Adobe, which of course has been under pressure for a couple of years now, trading on a 9 or 10% free cash flow yield, doing a significant amount of buybacks. That's kind of the Oracle playbook. Oracle was dead for a decade. They bought back 40% of the company over a decade. And so we're starting to see that already. Salesforce is doing that. They're taking the share count down. But the second part that we need to see, like I said, is the management teams themselves, the CEOs, the CFOs buying stock. We saw a little bit of that at SAP with the CFO stepping into the market and making $1 million plus purchase of stock. We need to see more of that.
Stefan, appreciate your time. Thank you, sir. Stefan Slavinsky there of BNP Paribas. Some of the carnage we've seen in software. Microsoft, year to date, down by close to 20%. We have lost $671.2 billion in market cap since the start of the year. Yeah. What name?
I mean, this is the reason why it's notable that the market, that the overall index isn't down even more. What is the metric for success or for the lack thereof? It is the growth of your underlying cloud business, your growth of the application of these services, paired with the growth of your capital expenditures. Are you spending in order for it to be defensive, to preserve your turf, or is it to be offensive, to win capital market share? And that, I think, is what people are focusing on.
We've got a bit of a bounce so far this morning. On the Nasdaq, we're higher by 0.6%. On the Nasdaq 100, on the S&P, up by 0.5%. With an update on stories worldwide with your Bloomberg Brief is Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. Republicans on the Senate Banking Committee are raising doubts over the DOJ's investigation into Fed Chair Jay Powell. Republicans increasingly view the probe as an unnecessary roadblock in a confirmation process for Kevin Warsh. Senator Tom Tillis said he would oppose any Trump-Fed nominee until the issue is resolved. Work on a $16 billion Hudson River Rail Tunnel project has come to a halt. The Trump administration decided last year to freeze funding for the tunnel, which was expected to ease congestion between New Jersey and Manhattan. The Gateway Development Commission has sued the federal government in an effort to unlock more than $205 million. Tesla is looking at multiple sites across the United States to start manufacturing solar cells. Sources telling us here at Bloomberg, the company plans to expand production at its Buffalo, New York facility and at another factory in that state. Tesla also weighing Arizona and Idaho for new additions. And that is your Bloomberg Brief. John.
Thanks, Vonnie. Appreciate it. Up next on the programme, signs of weakness in the labour market.
It's a complex job market, is a complicated situation and complicated data. You could get a zero or negative number. And I think that's where the underlying pace of job growth is running, somewhere right around zero.
Michael Collins of PGIM joins us next. No guarantees, there never are, but these are the moves this morning and we'll see if they hold into the open and bell and beyond. Equity futures positive by 0.5, on the Nasdaq up by 0.6. On the Russell, that outperformance again returns. The Russell 2000 higher by 1.23%. There was a different flavour to it all yesterday. We've talked lots about that extensively so far this morning. The weaker than expected economic data putting a bid into the bond market. 2-year bond yields down by 10 basis points. 2-year yields down to 348.31. 10-year yields up this morning to about 420, in the middle of the range of the last few weeks. Under surveillance this morning, signs of weakness in the labour market.
It's a complex job market, is a complicated situation and complicated data. Month after month, people are telling us jobs are becoming harder and harder to get. So I think it is a loosening labor market. Lots of statistical issues. If we get a big update to that birth-death model, you could get a zero or negative number. And I think that's where the underlying pace of job growth is running, somewhere right around zero.
So here's the latest this morning. Jobless claims and challenger job cuts raising concerns about the labour market, with the delayed payrolls report due on Wednesday. Michael Collins of PGIM Fixed Income writing, the labour market is flashing more red lights. The last handful of data points are all starting to hit levels of change typically associated with recessions. Mike joins us now for more. Mike, good morning. Begs the question, is this time different?
You know, I don't know, Jonathan. We've been on kind of a 5-year pattern here ever since kind of the boom in the supply and demand for labor following COVID. We've been on a gradual slowdown, as we've been talking about for months now, if not a couple of years. It seemed like over the last couple of quarters, maybe the labor market was stabilizing at a kind of a weakish level. But certainly the last handful of data points, as you just pointed out, look like a kind of a re-acceleration to the downside. But again, you know, you need a lot more data to really determine a trend. But the labor market looks weaker, right? And this whole kind of battle that the Fed is fighting, this tug of war between inflation and labor, it feels like the labor market will win out.
Governor Chris Waller doesn't need more convincing. He already voted for a rate cut last week and he dissented. He put out this statement, Mike. I'm going to share some of it with the audience if they haven't read it already. Last year's data will be revised downwards soon to likely show that there was virtually no growth in payroll employment in 2025. Zero, zip, nada. Let this sink in for a moment. Zero job growth versus an average of almost 2 million for the 10 years prior to 2025. And Mikey goes on to say, all of this suggests that a substantial deterioration in the labour market is a significant risk. So, Mike, when we're talking about rate cuts this year and the market's around 1 to 2, and we have economists come on the programme say, you know what, we expect zero. What are you expecting?
You know, it's a real tough call. I mean, 1 to 2 still sounds like the right number, but I think the preponderance of risks, Jonathan, is too much more cuts, or many more cuts than are priced in, right? I mean, the market is putting a very low probability on a funds rate kind of in the 2s or even 1s over the next several years, right? The markets have kind of consolidated around this expectation that the funds rate is going to stay kind of in that 3.5% for the next year or two. And then, believe it or not, looking at the steep yield curve, the market is actually technically pricing in the funds rate to go back to 4, you know, over the next 5 years or so. And I think that's where the markets are offsides, right? I think there's a higher probability that we end up with a 2 handle on the funds rate than a 3 or 4 over the next 5 years.
Is, at this point, given what you're talking about in terms of the backdrop, a risk-free rally or a rally in treasuries good for riskier assets, as has been thought for a lot of the past couple of years?
Yeah, Lisa, I know you're talking about the correlation between stocks and bonds, the age-old question, and a lot of our clients and a lot of investors are still spooked by what happened in 2022, where, you know, everything sold off together and the correlation did not work on your behalf. But we've been telling our clients, listen, this time will be different. You've had a reset in interest rates, right? Rates are relatively high. There is a lot of scope potentially for the Fed to cut rates if they had to, if you did have that big risk-off moment, if you did have a deceleration in the job market, if you did have a big crash, let's say, in the stock market as valuations come into question, if you did have a recession, I mean, there's a lot of scope, right? Trump talks about rate cuts, not in tens of basis points, but in points, like a mortgage banker, right? Like rates should be like hundreds of basis points lower, not tens of basis points lower. And who knows where we end up. But I do believe that correlation in a downside scenario, will support risk assets.
Listening to you, Michael, I'd rather buy a 10-year Treasury get 4.2% in terms of yield than go into Oracle debt and get 5.5%. I mean, how much does this crimp the appetite to go into debt that is tied potentially to pretty ambitious projects that are being put out there by some of the largest companies out there?
We have that trade on, Lisa, and I think that's the right call. I mean, the supply of debt is one thing, right? It's going to be massive, and it's just starting to increase. A lot of this capex that you've been talking about all morning, had been funded by free cash flow or cash on the balance sheet, and it is increasingly being funded in securitized credit markets, in real estate markets, and in our, corporate bond market. So that supply issue is one thing, but it's really the expectations of revenues that I don't think are going to justify this capex build, and I don't think it's going to justify potentially the valuations on a lot of these technology companies, and that alone could certainly cause corporate spreads to widen in sync with equities falling, right? So we're very defensive on the credit side.
You sound very bearish when it comes to some of those names. You have this moment in your note I love. The old adage of don't fight the Fed is being replaced, basically because you can't fight this presidency. Is that correct, Michael?
Yeah, my new line is don't fight the triumvirate, right? I mean, you have a president, you have a Treasury secretary, and I'm watching the debate, between Elizabeth Warren and Bessent, and a Fed chair ultimately, right, who all want rates to be, again, a lot lower, right? And there are tools these folks can use, other than old-fashioned, moving the Fed funds rate around, right? There are regulatory tools, there are issuance tools, right? And there's, balance sheet tools that can be used. So, I think it's dangerous to assume that the funds rate is going to stay at 3.5 and maybe go to 4 over the next 5 years when you do have this, I think, force that want rates a lot lower. So I think it's probably a good move to stay, in the bond market, to stay long duration. That's what we're doing. We've actually been adding a little bit of duration here on this recent backup, toward 430 on the 10-year.
Hey, Mike, it's good to see you. Mike Collins there of PGIM Fixed Income. Mike, have a good weekend. Mike usually joins us on Payrolls Friday. No payrolls this morning. We'll get that on Wednesday. And payrolls taking on a little bit more importance, I think, after the data of yesterday.
Given the fact that we got 3 data points, all of them not necessarily the gold standard that typically payrolls are. However, highlighting that this is a weakening labor market and that right now jobs are just not getting created and there is a potential for them to be eliminated.
That put a bid into Treasuries. Yields down at the front end by some 10 basis points. The first close below 350, I think, since the start of the year, the first week of January. Up next on the programme, Nadia Lovell of UBS, Gil Luria of D.A. Davidson, Stephanie Roth of Wolfe Research and Julia Herman of New York Life Investments.
There is a sentiment overhang.
We're coming to a point in the AI transformation where dispersion is much greater.
The AI boom is coming.
Rotation is the new momentum trade.
I think there's a number of narratives going on, and so investors are increasingly wondering, which ones do we want to pick?
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
We're almost there. We are almost there. Almost at the weekend. Live from New York City this morning. Good morning for our audience worldwide. The third hour of Bloomberg Surveillance starts right now. Equity futures on the S&P 500 positive by 0.5%. Here's the bounce following a 3-day rout on the Nasdaq. We're looking at the worst week on the Nasdaq 100 since Liberation Day week. Back in April of last year, the Nasdaq 100 looking to bounce up by 0.6%. Struggling to bounce this one right here in the pre-market. Amazon, $200 billion in capex. That's the intention for the next year. The stock is down by 8% in the pre-market.
Just to give some perspective, this company is spending significantly more than it was initially expected to spend. It was expected to spend some $150 billion, which also was an astronomical sum. Why are they doing it? The why is the reason that people are nervous. It is to catch up to the likes of Google and Microsoft. It isn't necessarily because they have the opportunity to see something that's really good. They don't want to miss something, and that, I think, is what is making a lot of people concerned.
$650 billion is spending across 4 companies. Surely the chip players should be winning the week. They haven't been. They are this morning. Nvidia, Broadcom rallying in the pre-market. In the last 24 hours, we've talked a lot about how the character of this sell-off changed, that it had a real economy flavour to it off the back of the weaker than expected economic data we saw yesterday. Next week becomes more important. Payrolls on Wednesday. Very much in focus. What kind of data are we going to see next week?
Also sprinkled on top of all of this is the fact that Anthropic is coming out and saying, look what we can do for you. In some of last night was about the financial sector. Maybe you don't need as many people. So that is why jobs and payrolls are going to be so much more important, not just about the data we've seen this week, but also what Anthropic is saying about potentially how AI actually might help companies reduce workforce. Not good for the real economy.
There's something Diane Swong said to me from KPMG last week when we were covering the Federal Reserve decision. And she was speaking to Tom and I, and she said that you could see GDP at fantastic levels, but you could see a jobs recession. Just imagine what that's going to look like over the next 12 months, if that materializes going into the midterms in November.
According to Fed Governor Chris Waller, we may have already seen that, because we might have seen actually negative jobs growth last year, or potentially just even flat. A real question here about how this trickles into the politics of this moment, and a real question about how much you can get ongoing risk appetite if you do have this type of pretty lackluster backdrop. I mean, again, I keep going back to what Michael Collins just said. If you have that backdrop, he'd rather own treasuries than Oracle debt or Amazon debt or Google debt or some of these others, given the fact that right now you're getting a pretty good return just on Full Faith and Credit US.
And it's not just the pushback when it comes to individuals and their employment prospects in America. I really was struck yesterday. I thought one of the most important things was the Michigan Attorney General. And what she is saying in terms of these contracts are simply too consequential for the future of energy affordability in Michigan to keep granting fast-track, secret review and approvals to untrustworthy partners like DTE, Oracle, and OpenAI. Massive pushback because consumers are going to be paying higher energy prices and then potentially might not have a job.
On a lighter note, this from Chris Harvey, and I hope that the Harvey family don't read his research. He said the stock market sell-off is not over. Sell-offs are like fish and family. After 3 days, it's over, or it starts going south fast. We do not think the sell-off is over. To us, the market starts looking interesting below 6,700. Thank you, Chris, over at CIBC.
And this is the reason why I don't have fish, because within 3 days, they'd be dead.
Oh, God. Well, I was just going to say, who's his family? I like hanging out with most members of my family. Maybe he's talking about in-laws.
I hope
they're
that the
not
Harvey
watching.
family don't read his research. Equity futures right now. On the S&P 500, firmer by 0.4%. Coming up this hour, Nadia Lovell of UBS Global Wealth Management as the tech rout deepens. Gil Luria of D.A. Davidson downgrading Amazon, saying it's losing the lead in the cloud space. And Stephanie Roth of Wolf Research looking ahead to a key week of data on deck. We begin this hour with stocks steadying following the Nasdaq 100's worst three-day stretch since April. Nadia Lovell of UBS Global Wealth Management writing the following. Sentiment has turned more negative lately. Even though market breadth has improved, we think the great broadening is well underway. Nadia joins us now for more. Nadia, good morning.
Good morning.
Let's get into that last line. I think it's important. What's driving that great broadening, and why do you think it's going to be resilient, sustainable for the year ahead?
You know, I think it's just the overall economic backdrop. Like, yes, we're seeing some sell-off in parts of tech. It seems to be more technical in nature, and it's not a significant shift in the macro backdrop. But reality is there's a lot of pain under the hood across the P&L. And so it does feel, though, that we're starting to approach maybe the end of that sell-off, just given how much valuation has come in, as well as just the overall pullback that we have seen. But I think back to your initial question around the broadening, it's going to be driven by the global growth backdrop, which can actually surprise to the upside. You know, you have spending in the four largest economies in the world, fiscal expansion happening. You also have that lag effect from more accommodative monetary policy and a potential for a Fed to further ease. And look, capex is going up for these hyperscalers. Yes, we know one person's spending is another company's revenue. And so we think that there's a potential for upside to global economic growth. So that 2.5% that we have for the U.S. might actually prove to be more conservative, you know, and so we think that that will help the broadening out. We're seeing that broaden out in earnings in the 493, and we think that that's going to help sustain the market as we progress in this year.
Should we ignore the jobs numbers then? What's more instructive, payrolls or the capex intentions of four companies?
They're both important, right? And that's going to help the economy on the business investment standpoint. On the labor market, we do have the Fed that will come to the rescue. Reality is yes, the data this week, not very encouraging in the labor market. We'll see what we get next week in payroll. But even though we had a hawkish, I would say, press conference at the FOMC last month, Powell did note that the Fed does remain the flexibility to cut rates. And so we think that if you see any weakness in the labor market that flies in the face of that stabilization in the labor market that Powell had pointed to, that would pull forward some of those rate cuts. So we could see another rate cut in March, before Powell actually exits. And so we think that can give some comfort to this market.
It sounds like you're saying that the rotation has legs because either the economy is strong, and that's a great thing, or the Fed's going to cut rates if the economy isn't strong, and that's a great thing for the rotation trade. Is that basically what you're saying?
Somewhat that, Lisa, absolutely. And I think that's why you're seeing there's more positioning in the cyclical side of the economy. You've been talking all morning about the ISM that we got earlier this week. So there clearly seems to be a cyclical recovery underway. New order growth, we'll see if that continues the next couple of months because there might be some quirks in the data. But I think that's helping out the broadening trade across some of the consumer. We know that the consumer is going to get some stimulus from tax returns, in the next few weeks, over the next few weeks as well. And also, I think, we are seeing some steepening in the yield curve, and that also is helping parts of financials, particularly banks. And so those are the areas that we're leading in onto the cyclical side. That doesn't mean that we don't see opportunities on the structural side. We think you just have to become more selective in tech, which we've been doing over the last couple of months.
As I hear you talk, what I'm hearing is there's a lot of money out there. And there's a lot of money sloshing in the system. And that's what I keep feeling also with this rotation that hasn't disrupted things, that there is just a mass of money where we can throw out $650 billion and say, okay, or $900 billion of market cap losses in 1 week from 3 companies. And people say it can be absorbed. Is there some sort of signal here about how much money there is in financial markets that's going into the real world that could potentially have inflationary ramifications that we haven't yet priced in?
Well, I mean, there is the argument for productivity gain, and that potentially dampens inflation as we go out over the next couple of years. So not overly concerned about inflation right now. I think also part of the broadening out, Lisa, now on that money slushing around is not just the U.S. anymore. I think that we've been talking to clients about increasing diversification, and I think that case has been strengthened, particularly when you see the pullback in tech. So we're also looking at opportunities outside the U.S., particularly in Europe or Japan. This weekend we'll get the snap election in Japan, and we think that the LDP is going to gain seat, and that will help push through the stimulus package and revitalize the domestic economy. So again, for the last few years, investors have been rewarded in the U.S., but we think that the opportunity set has broad, and that's why we still remain constructive on global equities, because no longer do you have to just focus on the U.S. and what's happening in the U.S. economy. You can look across the pond as well and look at Europe as well as in parts of Asia.
You're very constructive right now, but you do say that when it comes to tech, you're looking at specific names, and maybe the leadership is changing. What do you want to see? What names do you like?
So, when you look at tech, yes, reality is that bleed across software has been happening for months. We know that. It got accelerated in the last couple of weeks. But, I think fundamentally, when you look at even software, still growing, still mid-teen top-line growth, and we also recognize that the fact is, these incumbents also fully entrenched in the enterprise. And the enterprise software isn't just about writing code. It's about integration. It's about understanding complex systems. It's about managing governance. And so we do think that some of these software companies still have the edge. But that said, it's understandable why there is a pullback. So within software, what we're more focused on is those companies that are not so overexposed to seat-based models, right? And those that are vertically integrated. And then across the rest of tech, particularly the AI stack, what we're looking at is those companies that are starting to monetize AI, again, those vertically integrated, as well as in semis. It's not just the chips, it's also the memory stocks that we're looking at, that we've been adding to, and those that are involved in foundry as well as packaging. So I think you have to have that diversification, not only across the globe in terms of regionally, but also in sectors and also in these structural themes, and particularly across the AI value stack.
Just finally, year-end target on the S&P, 7,700?
Yes.
Do you think we've got 10% plus upside if software stays in the penalty box?
I think so. Can software stabilize here? feels like we're starting to get there. I mean, we're down. We're in bear market territory at this point.
Yep.
So it's more stabilization in software. The rest of tech, because that spending is benefiting the rest of tech. And then we have the cyclical parts of the market that are performing well. So when you put all of that together, unless you see any sort of major crack in the labor market or a major crack in growth, and we don't think you're going to see that in the economy, the fact is the data has been coming in pretty okay. We think that you can get to that 7,700. That greater participation will be enough to push it there.
Nadia, this was great. It's good to see you. It always is. Who needs payrolls? We've got Nadia Lovell of UBS Global Wealth Management. Nadia, thank you. It's good to see you. Thank you very much. Let's give you an update on stories worldwide with your Bloomberg brief. It's Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. President Donald Trump wants Washington Dulles International Airport and New York's Penn Station to be named after him. NBC News reporting the Trump administration asked Democrat Chuck Schumer to rename the transportation hubs in exchange for the release of the federal funds required to build a long-delayed gateway tunnel between New York and New Jersey. Anthropic is releasing a new version of its AI model designed to perform financial research and other workplace tasks. The company says Claude Opus 4.6 can scrutinize company data, regulatory filings and market information to come up with detailed financial analyses. And bigger bonuses for bankers. Goldman Sachs, Morgan Stanley, JP Morgan, Bank of America are boosting their bonus pools for bankers and traders by at least 10%. The decision reflects a strong year as the businesses benefited from deal making and market activity. Collectively, the banks posted their largest annual profit since 2021. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. More from Vonnie in the next 30 minutes or so. Up next, the Morning Calls Plus. Gil Luria of D.A. Davidson downgrading Amazon, saying it's losing the lead in the cloud space. That conversation up next. Live from New York City this morning. Good morning.
I think what investors are looking for is managements and insiders to step up and start buying their own stock. I think that would really kind of instill some confidence rather than just telling investors the sell-off is overdone, maybe launching some corporate buybacks. Management teams need to step up, insiders need to step up and show the confidence they have in the outlooks of their own businesses.
That was Stefan Slavinsky of BNP Paribas joining us a little bit earlier on. I talk about when moves like this happen, it brings the best out of Wall Street. Some great research out there at the moment. This came from Manish Kapur of SocGen, writing the following. US software stocks are down 17% year to date. They've lagged the S&P by almost 30 percentage points over the last 6 months. He goes on to say, this is the outlier, a sector that has delivered 13% annualized profit growth for the last 3 decades, almost double of the S&P 500, and built its status as one of the market's most reliable defensive engines.
How do you price in something that hasn't happened yet? And the promise that Anthropic put out there is essentially what we cannot price, which is mass disruption. And that's what these stocks are trading on, not necessarily the performance that not only analysts, but also the heads of private investment firms are trying to tell us day in and day out.
The worst relative performance in 25 years. Amazing. That's that from Manish Kapur over at SocGen. Equity futures doing better this morning. Let's check out the price action going into the opening bell, 1 hour and 13 minutes away. Equity futures on the S&P 500 positive by 0.5. The Nasdaq up, the Russell outperforming, the Russell 2000 higher by 1.26%. That's the price action. Let's get you some morning calls with one stock in focus, Amazon. First up, Cantor Fitzgerald lowering its price target to $250, citing concerns around long-term ROI. Your second call from Evercore ISI, slashing its target to $285, anticipating negative free cash flow for the year. And finally, Wedbush cutting its target to $300, noting investors need to see tangible returns from high capex. That stock is down by 8%. Let's stick with that name. A $200 billion capex price tag weighing on shares. Gil Luria of D.A. Davidson downgrading the stock to neutral and writing this. With the context of results from Microsoft and Google, we see AWS continuing to lose its lead and now scrambling to catch up through escalating investment. Gil joins us now for more. Gil, welcome to the program. Read the note earlier this morning when you published it. What stood out to me was this. It sounds like you think that $200 billion is starting to look a little desperate. Is that fair?
It is, because they're escalating their capex. So is Google, so is Microsoft, so is Meta. It's just that Amazon is not getting as good of a result as those other companies. Google is investing a lot, but they just grew their cloud business 48%. Microsoft grew Azure 39%, and that's just because of internal allocations. They could have grown it faster. Amazon is only growing that business 24%. More importantly, we look at the backlog that this investment has delivered so far, and we see that Google's backlog is comparable to Amazon's. Google is half the size. Microsoft's backlog is almost twice as high as Amazon, and they're the smaller business. So Amazon is investing a lot. It's just not getting as good of a result as Google and Microsoft. Google is lapping them, and Microsoft still has the lead in terms of delivering AI compute. That's why we're concerned.
Gil, do you think this is a structural disadvantage, a structural hole that the company will ultimately struggle to get out of?
Yes, and it's a result of a couple of things. It's a result of the fact that Microsoft aligned with OpenAI early. It has primacy there. And Google was able to create Gemini as one of the leading chats and AI engines, and that's giving them the lead. Amazon doesn't have either. It had an early investment in Anthropic, but Anthropic wisely diversified and is also getting investments from Google and Microsoft. So Amazon doesn't have the primacy there either. So the leading models are what are leading the race. Microsoft's aligned with one, Google with the other. Amazon is just trying to catch up.
Gil, is there any chance that Amazon could catch up? What are they investing in that could potentially get them over the finish line?
Well, that's why they're investing so aggressively now, not to mention the $50 billion they want to invest in OpenAI in order to get better access there. So they're going to try to catch up, but this race is happening very fast, and up until now, they're just continuing to fall behind those Microsoft and Google.
So, Gil, do you see this really as the reason behind the spending raising concerns for you, the idea of being defensive rather than offensive, and not this idea that the nature of these businesses is fundamentally shifting, where suddenly they are spending exponentially more every single year as they become more asset intensive and more like utilities and real estate managers than the tech companies that they once were?
The business is definitely shifting, and it is becoming a lot more capital intensive. We're not saying it's not a good investment, though. To be clear, Google, Microsoft, and Amazon, the reason they're building so many data centers is that they've booked those 3 years in advance. They have the customers. Let's not forget, combined between those three companies, they have all the customers. All business customers use one of those three. So when they're investing in data center capacity, it's pre-sold. We're not worried about the return they're going to get because their customers want this AI compute capacity and they're willing to commit to it in advance. What we're worried about is among the three, who's going to do better. And we don't think that looks like Amazon right now. But in terms of the return on the AI investment, those companies are getting the good return. But let's not forget who's really getting all the profits. That's NVIDIA. All three of these companies are now taking all of their cash flow and passing most of it to NVIDIA. And yet right now, NVIDIA is actually trading at a lower multiple than any of them.
Gil, when it comes to Amazon Web Services, though, I understand that potentially it's not doing as well as you're talking about with the other peers. But for them, it's the fastest pace for them in more than 3 years. Doesn't this show that actually when Amazon comes out and is talking about all this money, it is going to a part of the company that is growing within their portfolio?
Yes. Again, it's a good investment. They should be making it. They have to make it. They're just not getting as good of a result as Google and Microsoft. That's what we're saying. And again, they're trading at a higher multiple than Microsoft. Microsoft trading at 22 times, with Microsoft Azure growing 39%. Amazon trading at 26 times, with AWS growing at 24%. That means that Microsoft has a lead. It's more attractive as a stock. And again, we think they're going to keep the lead, if not extend it over Amazon.
Amazon's talking about they're spending it on AI, chips, robotics, and low Earth orbit satellites. Gil, is that the right place to be spending the money?
Well, most of their investment is still in AWS, and a lot of it's in retail, and they're getting phenomenal returns in retail, right? The fact that they can generate the level of profit that they do in retail while growing that business high single digits is very impressive. Our concern on the retail side has more to do with how quickly the internet is now changing. the internet used to be person-facing, like human-facing, and increasingly it's chat-facing. It's ChatGPT and Gemini that are increasingly driving traffic to the web. And Amazon has so far refused to allow those chatbots access to Amazon. So even on the retail side, where they're doing really well and getting great returns on robotics and distribution center investment and regionalization, even there, we have a concern that they could lose their lead, because if you're a Shopify merchant, your website is now linked to ChatGPT and Gemini. If you're selling on Amazon, it's not. And these things are changing very quickly. The volume on the web is turning from human to chat at a very fast pace. And for now, Amazon is emphasizing Rufus, which I don't think any of us is using, while ChatGPT and Gemini do not have a direct connection into the Amazon inventory.
Gil, can we finish on Anthropic? It's made a lot of waves this week, and I've really struggled to understand whether they're punching above their weight, whether the waves they've made are justified by their market position, whether a lot of the headlines this week is just the pre-IPO roadshow, or if it's actual real legitimate disruption. How are you framing things for clients?
Anthropic made the smartest strategic decision, which is to focus on code, on STEM, on math, on enterprise, on solving hard problems. And now their models are solving hard problems and are very focused at solving the types of problems that we have in the workplace, where ChatGPT and Gemini from Google have been more focused on consumer interactions. Anthropic has stayed very focused on solving enterprise problems, which is a very big pocket that they're addressing now. Now, I'm in the camp that believes that they're not going to replace all of software, but I do believe they're going to make us a lot more productive. And they're only starting to get paid for the productivity gains they're going to help enterprise customers get.
Gil, thank you, sir. Appreciate it. Thank you. Gil Lurie there of D.A. Davidson on the tech story of the week so far, and what a story it's been. The week isn't over. Equity futures positive by 0.6%. Up next, we'll catch up with Stephanie Roth of Wolf Research after a string of weaker than expected labour prints. Plus, Yahira is back with your morning movers. Stellantis, look at this move. Stellantis is down by 23% after a massive EV write-down. That conversation up next. On the week so far, down 2% on the S&P, down close to 4 on the Nasdaq 100. Here's the bounce so far this Friday morning. Good morning to you. Up by 0.5% on the S&P, on the Nasdaq 100 up by 0.7. The Russell outperforming, up by 1.4. 4 companies looking to spend up to $650 billion in the year ahead on capex, and yet still, those tech companies haven't engineered a boom in the chip makers. Nvidia is down on the week by 10%. Broadcom is down on the week by 6%. Those two names are trading firmer in the pre-market. Let's see how they open up with the opening bell just 60 minutes away. Let's get you some more single names, some morning movers. Yahira has more. Hey, Yahira.
Hi, John. Amazon getting hit hard for being one of those big spenders. Shares are down 8% in the pre-market as it pours $200 billion into AI infrastructure. It's a move that CEO Andy Jassy says it's necessary since at AWS, he says that they're monetizing capacity as fast as they can build it. But the problem for investors is that it is already projected to hit the bottom line, with Amazon's forecast for operating income in the current period coming in below estimates. Meanwhile, moving on to our big mover to the downside, and that is Stellantis. Shares are down more than 23% in the pre-market after the automaker said it would take a $26 billion hit as it scales back its EV ambitions. Stellantis admitting that it went too aggressively on EV demand that just didn't show up. So it joins the likes of Ford and General Motors, who have also had to take big write-downs. And we end on Roblox. This is the gaming app popular with kids, and it had been caught up in this AI firestorm. That's because Alphabet came out with a tool allowing users to create their own virtual worlds with characters, and that's very similar to what Roblox offers, but it came out with a solid earnings report. It beat, so shares are up more than 10% in the pre-market. John?
Yahira, thank you. Thanks for this morning. The broader market doing okay, up by 0.6%. Big week ahead. Payrolls just around the corner after several data points this week so far opened the door to a conversation about rate cuts. Mike McKee has more. Good morning, Mike.
Good morning, John, from Atlanta, and I'd like to wish you all a happy non-jobs day. The government shutdown, of course, postponing jobs until next week. But that doesn't mean there hasn't been a lot of employment news this week that, as you mentioned, John, has opened the door to more talk of rate cuts because the news has been universally bad. We saw ADP come in much lower than expected. We've seen the the jobless claims numbers come in higher than expected. And, of course, there was that big Challenger miss or report of job losses, the worst since 2009, that came out yesterday. So since that's happened, we've seen Fed funds futures price in a rate cut in June, which would be Kevin Warsh's first meeting as chair, if indeed he is confirmed. Now, it doesn't mean a whole lot because, of course, we do get the jobs report next week. And we also get a lot of stuff next week that is on the other side of the mandate. That's why it is a huge week for everybody. We start with inflation and the New York Fed's inflation expectations numbers. And then we see on the ECI come out on Tuesday, the employment cost index, along with import prices. And retail sales will see some strength maybe in December. Wednesday is the jobs report you talked about, and then Thursday, jobless claims, and then Friday, CPI. So we've got jobs and CPI next week. There's going to be an awful lot for people to process in terms of what it all means for rate moves coming up.
Mike McKee, thank you, sir. Mike McKee down at Atlanta, Georgia. Look out for this interview a little bit later on today. He'll be sitting down with the Atlanta Fed President, Raphael Bostic. I should say the outgoing Atlanta Fed President, Raphael Bostic. He steps down at the end of this month. This is a man who's indicating he thinks they shouldn't be cutting rates at all for the year ahead, on the very other end of the spectrum compared to, say, Governor Chris Waller.
Yeah, and I'd be actually very curious to see what he says on a day like today after we got the labor market data that we got over the past week, given the fact that it points to a weaker than expected labor market. Does he still expect there to be this stabilization in the employment picture, as Fed Chair Jay Powell has indicated?
Especially as Jonathan reiterated what Governor Waller had to say recently, the fact that for 2025, it's going to be revised downward, likely to show that there was no growth, zero, zip, nada. What do you say to that?
Sticking with the labour market, this is what Stephanie Roth of Wolf Research has got to say to that. While the data was disappointing, we wouldn't read too much into the latest prints, nor are we changing our view that the labour market should improve from here. Stephanie joins us now for more. Stephanie, good morning.
Good morning.
Why should we ignore Challenger, jobless claims and JOLTS?
Okay, for claims, they rose to 230,000. Historically speaking, that's not such a bad reading. There was a lot of weather disruption that week. When we were talking about Challenger, a lot of it was driven by UPS, which had a similar announcement last year. And the Challenger said itself that it's going to be driven by attrition and voluntary separations are the big part of it. Another reason for Challenger was Amazon. So the bulk of the news was coming from either tier 3 data or data that's not necessarily indicative of a labor market that's actually deteriorating from here. We'll have to see what payroll shows. And our sense is that next week we'll learn that payrolls for January were fairly decent. And then, of course, there will be those downward revisions historically.
I'm totally with you. And I got the Challenger jobs cuts. We were all looking at the idea that this was really concentrated in 3 companies that have already announced a lot of these job cuts. Then the jobless claims come out. Yeah, it's at an 8-week high, but ultimately still at a pretty low level. Then JOLTS comes out and you look at it and it's saying, look, we're looking at the lowest job openings going back to 2020. I mean, how many of these can you explain off before you start to get a little self-conscious? Wait a second. Maybe something else is going on here.
I mean, I think you have to take a step back and reassess your view. But our sense is, one, the consumer path is pretty good. We're going to also have fiscal stimulus that is starting to hit. The momentum seems to be improving. If you rewind just a couple of days ago, we were looking at the ISM, and we were starting to get questions of, is this early cycle? So how can it be both early cycle and late cycle at the same time? Our sense is that we are starting to improve cyclically. There were some negative news from some of these data sources that's probably not indicative of the trend. This happens very frequently, especially in the month of January, where you get some prints, especially associated with layoff news, which tends to be a January phenomenon.
Well, maybe it's early cycle for fiber optic cables, but it's late cycle for humans that are actually trying to enter the workforce. I mean, how much do you glean that some of this weakness truly is coming from less human-intensive jobs that really result from some of the capital expenditures that are supporting economic growth?
There might be an element of that. So we ran some estimates looking at the rising unemployment rate since ChatGPT launched. And we found that about half of the rising unemployment rate was tied to AI, and then the other half was more cyclical in nature. So the extent to which, sure, there is half of it that is structural that will probably continue to rise, but the portion of it that is cyclical might actually reverse this year if we actually do get a cyclical improvement in the economy. So we do think that you could see about 1 to 2/10 of downward pressure on the unemployment rate this year, just because of economic uncertainty fading, given last year was true peak tariff uncertainty, a modest improvement in the consumer, in which case you could see some modest hiring across cyclical industries.
ChatGPT was launched in 2022, and they're taking 50% of the jobs right now. How does the Fed deal with that?
It's a tough backdrop. I think they have to be thinking about the productivity. And it's kind of a call about whether this is a productivity cycle. There's no harm in waiting at least through the middle part of the year, which is probably what the Fed's going to ultimately end up doing. And then in the back part of the year, they could probably cut a couple more times, and Warsh is going to guide them towards that, because that will be an environment where inflation is also starting to fade. When in productivity cycles, you don't have inflation problems at the same time the growth is strong. So if we start to see that inflation cools down, then it's an environment where they can still cut a couple more times.
What will be the main driver of disinflation? Torsten Slok was out a note today, and he was talking about actually you could see inflation creep higher with things like the One Big Beautiful Bill coming out. For you, what is disinflationary?
So in the first part of the year, I think that's right. We're going to probably see inflation move a little bit higher, in which case that's why we don't think that the Fed is going to be cutting under Powell anymore. However, in the back part of the year, it's going to be driven by the typical disinflationary forces that is tied to productivity, which is lower wage inflation than would otherwise be the case. So first part of the year, I agree. We're going to likely see some pretty hot inflation prints, especially in Q1. That will probably start to fade, and then the narrative will shift in the back part of the year, because that's when you'll start to see inflation cooling, and then labor costs also fairly modest.
I don't expect a precise number from you, but just how much of GDP growth this year is going to come from the tech capex? Not just the 4 companies, but everybody else as well.
Yeah, I think it'll probably be 50 or so basis points on GDP.
That's pretty impressive stuff. This is why it's interesting for the Federal Reserve. They could be cutting interest rates, potentially responding to a labour market at the same time GDP is close to 3. You ever seen that before?
It's a very unique environment, and that's why they certainly will have a tough time cutting in the first part of the year when you see growth actually accelerating. So the news this week, I think, is perhaps a bit of a one-off, and we'll shift to data prints that are starting to surprise to the upside. Consumer data starting to pick up, sentiment improve, companies want to invest again because the economic backdrop is a bit better than where it's been, in which case the fears about the economy really decelerating, the labor market crashing.
Well, it's basically what they did do at the end of last year. They were basically cutting interest rates with GDP 3-4 percentage points high because of what we saw from tech capex, even though payrolls growth has totally stalled.
Look, they've been looking through this. They've actually been acknowledging that a productivity boom could come at the behest of an employment market that is sluggish. The one challenge to this, and the one thing that I've not heard people fully explore, is how do 4 companies spend $650 billion in 1 year without causing inflation? Because ultimately what they're buying, yes, it's raw materials, it's land, it's housing, it's all of these different aspects. It's a lot of money. So how do we get that kind of spending without any kind of price distortion on the other side?
Stephanie, how does it show up in GDP? Does it come up through imports, investment? How does it show up?
So the way that we've been tracking it in GDP is looking at only the domestic portion of it, because it gets funky with the imports, because imports end up being a negative on GDP just based on GDP math. So we look at it based on the tech portion of capex, the construction, and what we find is that tech-related domestic portion of AI capex is about in terms of size, is about 1.5% of GDP. So that compares to, say, housing, which is about 3.5% of GDP. So it is large, it is growing. If Jensen's forecasts are right, it'll grow to 5% of GDP by the end of the decade. I'm not sure I would bet on it being quite that high. But it's an important part of GDP, but perhaps not as big as some of the other major drivers.
Why is it not inflationary in any way?
I mean, I think it is modestly inflationary, certainly offsetting some of the disinflationary forces that are playing out otherwise. And when you think about these typical productivity type of booms, it ends up being modestly inflationary in the near term, and then in the medium to longer term, it becomes disinflationary as you actually see the productivity gains as a result. We haven't really seen much of that productivity gain yet. I think it's coming. So for the first part of the year, you'll probably see those inflationary forces because there's a lot of positive demand shocks in the first couple of months, which is why I would emphasize the data that we got this week flagging that the labor market is starting to soften is probably not the right takeaway for the next couple months.
What's your guess for next week, just quickly?
On payrolls, 85,000 with some substantial downward revisions to the prior months.
Okay, good to see you. Thank you. Stephanie Roth there of Wolf Research looking for 85,000. The high next week's 135. That's Citi. The low is negative 10. That's Standard Chartered. Steve Englander had a lot to say about the payrolls data earlier on this week. Check out that interview if you haven't seen it. The median estimate in our survey is 70,000.
You know, to Steve Englander's point, even Priya Misra said, watch the revisions, because they're going to do a full revision for the prior year and a revision in the methodology, and that could really shift our expectations of what we can expect going forward and what we just saw in 2025.
Payrolls data next Wednesday. 2 days later, CPI. That's the calendar for the week ahead. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. The search for 84-year-old Nancy Guthrie is in its 6th day now. The Pima County Sheriff's Department says neither a suspect nor a person of interest has been identified in the disappearance of the mother of Today's Show co-host Savannah Guthrie. The FBI is offering a $50,000 reward for information leading to Guthrie's recovery or the conviction of people involved in her disappearance. Brevin Howard Asset Management's Minal Bathwal is one of the world's most successful macro hedge fund managers. Bathwal hasn't had a single down year since he started managing money during the 2008 financial crisis. His fund has scored wins on everything from Korean investment, interest rates to Asian currencies. President Donald Trump launching a new website to help Americans buy medication at a discount. The president saying more than 40 medications will be available through the site, including Novo Nordisk's Ozempic and Wegovy for $199, as well as EMD Serono's fertility treatment. That is your Bloomberg Brief, John.
Hey, Vonnie, thank you. Thanks for this morning. Up next, we'll set you up for the day ahead. Plus, Julia Herman of New York Life Investments assessing the big tech sell-off of the week so far. From New York City, you're watching Bloomberg TV.
You got to go company by company, be far more selective, and can't say I'm just going to own the whole lot of them. There will be winners, there will be losers. We knew all along AI is going to be quite disruptive. The question that investors should ask themselves over the next few years, is it disruptive to more businesses than it is beneficial, or is it beneficial to more businesses than it is disruptive? And I'm still in the latter camp.
Brian Levitt of Invesco is still bullish, joined us a little bit earlier on this morning. If you're just joining us now, welcome to the program. Your scores look like this. Equity futures on the S&P 500 higher by 0.5%, following a 3-day slide on the S&P 500. On the Nasdaq, bouncing back by 0.6. We were heading towards the worst week since April of last year. Let's see if that changes going into the opening bell and beyond. Switch up the board and get to the bond market. 2-year yields down 10 basis points in yesterday's session off the back of weaker than expected economic data. 2 sub 350 at 347.49. Yields higher on the session by some 2 basis points. The misses we saw on the data yesterday just adding a bit more importance to the data we get next week and over the next week. Your trading diary looks like this. At 10 a.m. Eastern time, we'll get you, Mitch, consumer sentiment. Look out for that. Over the weekend, elections in Japan. On Monday, Fed speak from Waller and Bostic. Wednesday is the main one, the big one. The January payrolls report. On to Thursday, jobless claims, and on Friday, some CPI data.
I just think that if it's not Friday payrolls report, does it have the same importance? Does Wednesday payrolls have the same ring? Look, we're going to get that data point. What does it tell us not only about the month of January, which is noisy and typically highly seasonally dependent, but also the revisions to all of 2025 to get a sense of the momentum heading into this year?
What would the Super Bowl be if it was played on Wednesday?
Right?
Totally with you, Bram. It's just not the same.
It's just not the same. I mean, does it even matter? Does it have the same ring?
No one's going to tune in. The audience is going to drop off. No one wants to see that.
NFP Wednesday, not payrolls Wednesday.
You know,
it doesn't work.
Payrolls Wednesday, 8:30 Eastern time. Tune in. Let's turn back to your top story on Wall Street. Alphabet, Amazon, Meta, Microsoft forecasting a record $650 billion in combined capex for 26. Julia Herman of New York Life Investments writing capex, once enough to drive AI conviction, now needs to clear a higher bar. Proof of faster monetization. Julia joins us now for more. Julia, good morning.
Good morning.
Feels like this has been building for a number of months now. Is the market starting to push back?
Yeah, absolutely. We're essentially seeing a shift from total focus on
on the infrastructure layer of AI and big support for how much infrastructure AI is going to need, to a focus on the application layer, how it's used. And honestly, I see a lot of impatience in the market in wanting to determine winners and losers in software, in wanting immediate monetization of AI capabilities. But those conversations are 3 to 5 years or more premature, in my view. I think where the market is going to have to come back to, yes, today, but maybe also in the next few quarters, are two key hubs of conviction in AI. The first is, are the core profit centers of these hyperscalers doing well? Those earnings hubs have nothing to do with AI just now, but they enable the second key hub, which is for the recycling of operating cash flow back into capex. As an investor, the number one reason I have to believe in AI as an investment theme is because these hyperscalers believe in their own theme. And so we actually see capex as a support of this conviction as opposed to a detraction from it.
One surprise we've seen through the week is to see this number, 650 billion, and then see stocks like Nvidia trade lower. Broadcom trade lower. Those two names are up in the pre-market, but Nvidia on the week is down by 10%. Does that make sense to you that semis have struggled this week in the face of spend that big?
Well, you know, I think that sometimes everything is painted with a little bit too broad of a brush. And the reality is that this is a complex supply chain, right? And NVIDIA is in a completely different part of that supply chain than some of the other hyperscalers, Microsoft, Meta, Google, et cetera. And honestly, what I would expect to see from here is a focus on that core profitability. Not just that, but even as leverage enters some of this financing, that is a prudent capital structure decision. That financing has become 175 basis points cheaper on the front end of the last 18 months. So even as more leverage enters this zeitgeist, I would expect to see maybe more of a market demand for monetization, yes. But we should also probably see a recognition that as long as actual cash flow is behind this AI boom, that we can keep going from here, and that money is, again, going exactly where these companies, where their mouth is.
There are a number of investors who are looking at U.S. tech companies and saying, I don't like your business model anymore. I like China tech companies that are looking on building up much more on this asset-light type of model and not necessarily the infrastructure that is really expensive. Do you agree with that? Do you think that tech ex-U.S. is actually looking more attractive as the U.S. model goes heavily into infrastructure and real estate?
Well, up until this point, international growth equity has actually not been the play. We have actually seen value outperform in those segments. In terms of how early we are in the development of AI, though, I think that all of this competition is a healthy thing, right? DeepSeek early last year was seen as the great threat to AI. But actually, isn't it a really positive development that maybe this can be done with a little bit less energy? And given that we're so behind in the infrastructure that we do need for AI, not just in the US, but globally, further competition, model efficiencies, I think all support the 10-year thesis around AI, even if they create bumps in the next 1-year thesis.
At the beginning of this year, a lot of investors were saying that they preferred equity exposure to debt exposure, given the potential for growth. Is that shifting? Do you now get the sense that some people are saying, wait a second, maybe the equity exposure is a little less clear based on the spending programs and the debt side looks better? Do you agree with that?
I think that in general, conviction in the AI theme is still there. And I think what's happening in fixed income markets is the proof in the pudding there. We are seeing debt investors gobble up the exact same issuance that equity investors are now saying that they're concerned about, right? And you're also seeing small cap tech do reasonably well. So that tells me that there's still conviction in this overall theme. The jitters that we've seen hit large cap growth, I think, are more about valuations and concerns about where allocation has ended up, given that diversification rewarded investors last year.
So you sound very constructive on this, and you think potentially this is going to be a washout, and these are still companies that people should get behind.
Yeah, I do, absolutely. We did a lot of long-term research on this theme, and honestly, our conviction in AI rests on the fact that if you compare AI to historical waves of innovation, it has all the right ingredients. It has public participation, public funding. It has the actual private sector helping the rubber meet the road. And there's also this sense that this technology is universal. One proxy for that would be to measure retail investor participation in the Magnificent Seven, for example. So over the next 10 years, we have incredible conviction. And in the short term, what we're looking for to bolster that conviction is, again, are these core non-AI profit centers remaining strong such that they can enable further capex financed by both cash and an increasing degree of leverage in the next few months?
Julia, this was smart. Thanks for making time for us.
Yeah, absolutely.
And welcome to the program, the first appearance as well.
Thanks
for being here.
Thank
you. Julia Herman there of New York Life Investments on the AI trade and the rout of the past 3 days.
We've just heard a number of people push back against it and say, hold on a second, there's a lot of value here. Question is, how do you value that, right? And I think that ultimately there will be a lot of discussion about this in the months ahead. Is there a different multiple put on some of these names as they continue to plan spending programs that would take us to the moon?
Also, I've been thinking they had to come out and announce more capex than they did the previous years. What level would have the market liked? Because at some point, if it was too low, we could have also seen pushback as well from investors saying, actually, these companies should be spending a lot more if what they are promising is so big.
You joke, but they are literally spending plans that will take us to space.
I'm serious.
Yeah, data centers in
Right.
space. Elon Musk and Jeff Bezos want to put data centers in space.
What a week it's been. $650 billion.
We're going to space.
The intentions to spend from these big four companies, just amazing. Equity futures up by 0.5% on the S&P 500. The final day of a very, very busy week. Looking ahead to next week, CPI and payrolls on deck. Payrolls on Wednesday, inflation data on Friday. Coming up on Monday to preview the week ahead, we'll catch up with Cameron Dawson of New Edge Wealth, the former Fed Vice Chair Rich Clouder, Jill Carey Hall of Bank of America, and Austin Kwon of Wells Fargo. From New York City, have a wonderful weekend. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.